The Fed needs to stop fixing to do something and actually do something.
It's hard to have much of an inflation problem if wages are still quite quiescent.
Since the pandemic, my argument is the Fed is changing policy.
Regardless of what the Fed does or does not do, the U.S. economy is going to grow somewhere 6, 7, 8% this year.
2022 is going to be a year of deceleration. The economy is going to be strong, but it's going to be growing slower.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. It's a simulcast on Bloomberg Radio, Bloomberg Television, and it is Jobs Day. Joining me, Matt Miller this morning, and Taylor Riggs wanders in early this morning. Thrilled to have Taylor with us as well on a Jobs Day. And I would suggest, Matt Miller, the entire world looks on America after what we witnessed 30 days ago.
Yeah, absolutely. The biggest negative surprise in history. Now we're expecting a slightly smaller number. I think the survey's for 674, but the whisper number continues to climb. If you check out that function on your Bloomberg terminal, WHIS Go, you can see that we're now at 800,000. I love that function, Tom. So it'll be interesting to see what happens today. I wonder what would happen if we had another big miss.
Well, that's exactly right, and that would be a value add there for folks. We'd never get that from John Ferro. I mean, Miller just crushing it with the terminal knowledge. Here's what you need to know. The survey in the last day, off of what we saw yesterday with claims, off of what we saw with the ADP report, has gone from 655,000 out to a new survey statistic of 674, and Mr. Miller talks about a number of 800,000 as well. Taylor Riggs, how do you frame this Jobs Day?
My favorite research note that I read is that the inputs are so sensitive, Tom, that the outputs could range from 0 jobs to 1 million jobs based on one little sensitivity of the inputs. So it certainly is perhaps maybe the inputs that are creating the outputs. And it is a wide range. And we await after that April number what we get today in terms of May.
It's a huge wide range as well. And, of course, the market's wrapped around this. Taylor, I know you were looking at this on the close last night. And very importantly, the market has shifted, folks. It's very important to go on a 4-day work week from the compression of a correlated Tuesday into the mess we saw, the stew rather, maybe of Tuesday and then Wednesday and into Thursday. And today, Taylor Riggs, when I look at the market very briefly here, I see a market pricing in that whisper number Matt Miller's talking about.
You know, my interesting comments, of course, around the magnetism of a 10-year yield around a 162. We've been talking so much about this range bound of a 160 to a 173, but it's 160, 162 that's been holding in there, Tom. Despite yesterday, the better than expected ADP, the jobless claims, you're sort of getting that inflationary, reflationary feeling, and yet it is the magnetism of a 162 that remains today.
Well, let's start with that on our data check here this morning, and I want to bring in the real yield as well, the inflation-adjusted yield, because that has moved as well. The 10-year yield, as Taylor mentioned, is 1.63%. The real yield has moved decisively, a negative 0.88, call it, into negative 0.82. That's a lesser negative statistic. And to me, that's a big deal, Matt Miller, that we've seen that real yield shift. And Matt, Brent crude still rounded up $72 a barrel.
Yeah, Brent crude and NYMEX both at pretty high levels, although I remember quite well just a decade ago when we were looking at 146, 147, and I believe the Saudis still need a little bit more to balance their budget. So even with these levels, I think that OPEC Plus wouldn't mind seeing it climb a little higher.
A churn to the markets in the equity space as we look cross-asset, red and green on the screen. The VIX 18.09, and that's center tendency between the 19 level and the 16 level, and really an odd week. Looking for data, and we'll get that data at 8:30 as well. We need a view forward. This is a view forward on the American labor economy. I'll be speaking with the Secretary of Labor near the 10 o'clock hour. Taylor, what do you have?
It is the only thing that we care about today. It is 8:30 a.m. that U.S. May payrolls report. That is the only thing that we are counting you down for. And then, of course, 9:55, John, your U.S. Tom, I should say, your U.S. Labor Secretary Marty Walsh interview. One of these days, I'll figure out the difference between Tom and John. And then finally, Tom, of course, 10:15, we're going to hear from President Joe Biden, of course, on that jobs report. And so certainly a lot going on as we count you down starting to 8:30.
Well, there we are, the summary of the morning's festivities. And of course, all of this to get into the weekend and to get into this with a restatement almost in this pandemic, all the different dynamics that we see within our financial system and our economics. That is a perfect segue into the former governor, the Federal Reserve System. Randall Krosner joins us now, the Booth School, Chicago, ensconced, I believe, in London, where he's been for many months. Professor, thank you so much for letting us start strong on this Jobs Day. As you see this labor economy and the battle of our politics as well, how close are we to fully employed?
So we're not there yet. We clearly have a very strong labor market. Even though the print last month was for a low number of jobs, it's clear that we have lots of reports of labor shortages. We see that in the Fed Beige Book. We see that in just talking to business people. It's a strong labor market. We're recovering very quickly, but a lot of people aren't coming back into the jobs market. Part of that is because they've just decided it's too volatile, it's too risky, I'm going to stay out. And part of it is they're getting some very good benefits that eventually will fall off. So I think it's pretty tight. And I think the thing to focus on will be what's happening with wages. Exactly as you guys were discussing, the numbers could bounce all over the place, and it could be lower because of supply constraints, it could be higher because of high demand. But I think we have to look through that and sort of see what is the wage pressure that's coming in. I think that's really going to be the key.
You know, Governor Krosner, a very careful and scary course at the University of Chicago is economics for liberal arts majors. It's just, it's a frightening event to see. And I'm sure what you're doing in economics for liberal arts majors is underscoring the complexity of our labor system. Neil Dudd at Renaissance Macro absolutely nails the key distinction right now is, are we seeing a longer work week, or are we seeing more jobs? At some point that flips to more jobs, doesn't it?
Yeah, I think, and clearly if you look at the number of job openings that are out there, it's enormous. There's been an enormous increase in that. And we're also seeing that people are willing to quit their jobs. They only quit their jobs a lot when they feel pretty confident that they can get another one. And so I think there are lots of job openings out there. There will be lots of opportunities for people. It's just, are there enough incentives for people to come back into the labor market?
What do you think of this paradigm change that we're watching, Randall Krosner, in terms of the shift from monetary policy over the last 40 years, from the Reagan-Volcker era to this new era of basically MMT? It seems that the freshwater economists have all been drowned in salt water here. There's no more trust in free markets. There's no more real business cycle. There's no more monetarism. What's the point then of the Chicago Booth School?
Well, I'm not quite sure that we've been drowned quite yet. I think there's still a lot of belief in the power of markets and the value of market economy. I mean, that's a lot of what's driving the recovery. Think about what happened during the pandemic. It was the innovative sectors that were allowing people to get food, to get the things that they needed. So I think that's still a super important driving force. Think about the creation of the vaccines. That was very much a market-driven phenomenon. So,
but Professor, we're going to run up debts of 120, 130% of GDP. Is that concerning to economists in America?
Oh, for sure. That's a separate issue. And so I think that's a very important one. It seems that there's a desire on some people in Washington to kind of supplant the private sector investment with government sector investment, with private activity with more government-sponsored activity. That is a real challenge. And I think there are many economists, not just in Chicago, but throughout the country, who are very concerned about that, concerned about the burden that we're putting on future generations. Somebody's got to repay this debt, and that's going to be the future generations.
And Professor, we've increasingly heard that there's no amount of tax increases that can cover that. And so you do have to bring in the private sector to help fund some of the public investments. Do you see that as a realistic possibility?
I think that's extremely important, and I think that's extremely valuable. And so we can have good public-private partnerships, like the one with the so-called Operation Warp Speed, which helped to allow Moderna who had never produced a vaccine before, now to be producing perhaps 1 billion vaccines this year. So there can be valuable public-private partnerships. There can be valuable aspects of government spending, but you've got to be careful to make sure that it has payoff. Because if it doesn't have payoff in helping to grow productivity and helping to grow the economy, it's going to put an unbearable burden on future generations.
Governor Krasner, I want to go Chicago on you, and that is over the financial integrity of the system. You're one of our great voices on this. I know you're on your laptop at some shishi cafe in London day trading AMC or GameStop. Randy, what in God's name does this mean for the system? I mean, you and I are making jokes about this, but you know a lot of money's going to be made, a lot's going to be lost. Regulators are clearly doing next to nothing on this. What's the impact of this on the trust in the bid and the trust in the ask?
I think it's a super important question because the integrity of the markets is crucial, and we've seen a lot of newcomers into markets, and we've seen a lot of coordination of those newcomers in markets in ways that we hadn't seen before, people using technology. So regulators need to be aware of that, and market participants need to be aware of that. Greater volatility, and we want to make sure that markets function well. We don't want sudden stops of trading, that where people feel that they are not being treated fairly and other people can get in and out and they can't. And so I think that that means a regulatory rethink for the new era where there are a lot more people coming in and people coordinate in ways that they couldn't before. So the little guys all working together can be much bigger than and more important than the traditional big guys.
Professor Krasner, well, we'll have to leave it there. Professor Krasner, thank you so much for joining us today with the Booth School at the University of Chicago, and of course his public service as a governor of the Federal Reserve System. Futures at -1, down futures at -44. I'm going to call it a very quiet red and green blinking across assets on my Bloomberg terminal. I do note the real yield definitely does better as we did the survey numbers improve off the economic data yesterday. We will go through the jobs report. We'll go beneath the headline data at 8:30. And then near the 10 o'clock hour, my conversation with the Secretary of Labor on labor in America, on rising wages, the fear of small business that they can't afford those higher wages. Stay with us through Jobs Day. This is Bloomberg on radio, on television. Good morning.
With the First Word News, I'm Ritika Gupta. President Biden is turning to taxes as a way to get a compromise agreement on infrastructure. The president has pitched Republicans the idea of a 15% minimum tax on U.S. corporations. For now, the president is setting aside his proposal to raise the corporate tax rate from 21% to 28%. Traders are waiting to see what the new U.S. jobs number is like. The May unemployment report is out at 8:30 a.m. New York time. According to a Bloomberg survey, the economy created 674,000 jobs last month. Economists had forecast a big number for April. Instead, employers added just 266,000 jobs. And European Union regulators have opened a formal investigation into Facebook. They want to know if the social network violated competition rules by using data gathered from advertisers to compete against them in classified ads. Facebook says it will cooperate with the investigations to show that they are without merit. China has started a war on commodity prices that Goldman Sachs says it can't win. Surging prices of raw materials threatened to derail China's recovery. Over the last 3 weeks, policymakers have unleashed a barrage of rhetoric and administrative measures to rein them in. Prices of coal have fallen as much as 22% from their highs in May, but Goldman Sachs says global demand will overcome attempts to stop that rally. Vivendi is in talks to sell 10% of Universal Music Group to a blank check firm backed by billionaire Bill Ackman. A deal would value the world's largest music company at more than $42 billion, including debt. Vivendi plans to spin off most of its UMG later this year and list it in Amsterdam. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
It's really about the labor market, tightness in the labor market, that driving up wages getting into prices, and then does the increase in prices start to affect inflation expectations? I think that what we're seeing now in inflation is going to turn out to be transitory. It's hard to imagine a big wage inflation spiral at this point in time, given that you still have 8 million jobs short of where you were going into the pandemic.
Bill Dudley there. Really, really interesting comments yesterday from a set of wonderful guests there on where we're going on inflation and the state of our politics in America. We welcome you to our Jobs Day coverage. We're going to do a number of things here as we move forward besides fix our bow tie. On radio, I'm adjusting my bow tie right now. I know you can see that coast to coast. We say good early morning to San Francisco, waking up to Wall Street. Futures -2. John Ferro and Lisa Abramowicz off, joining me. Matthew Miller in Berlin, and also Taylor Riggs joining us this morning. Right now in Washington, Emily Wilkins. Emily Wilkins, I look at the 9th Congressional District of Tennessee and Stephen Cohen, the Democrat of maybe this is Memphis, taking a song from a number of years ago. There is a bridge in Memphis that doesn't work across the Mississippi River, across I-40. That bridge is down and down and down for good. Infrastructure is front and center here. Are we going to get it done to create jobs in America?
So there are two different things to look at today. Number one, big thing, President Biden meets again with Republican Senator Shelley Moore Capito. She's been leading Republican senators in these negotiations. And yesterday we saw the White House again kind of say, hey, we're trying to find a way to work with Republicans, and here's what we're going to propose. President Biden said, don't look so much at that 28% corporate rate to pay for this potential infrastructure agreement. Look at a minimum corporate rate of 15%. So the idea is that regardless of how many credits or deductions companies pay at least 15%.
Emily, did the senator from Delaware walk away from the liberals yesterday?
There are progressives who have been increasingly frustrated. I assume that you're talking about President Biden. They are frustrated with him because he is going so low on a deal. We heard yesterday from progressives saying, look, that $2 trillion was already too low for us. And you're also seeing more pressure on President Biden to really come to an agreement. Yesterday, we had House Majority Whip Jim Clyburn on Bloomberg Surveillance, and he said, look, negotiations are ongoing, but we need to figure out how to move at some point soon. If Republicans aren't cooperating, we need to just go ahead and Democrats need to get it done by themselves.
Emily, there is a sense, though, we were speaking with Professor Krosner about this, that there's no amount of taxes that can fund the debt and the deficits that we're accruing at this moment. So you, at some point, have to bring in the private sector. Is there any discussion of pulling in the private sector?
We have seen discussions about public-private partnerships as potentially being a part of this deal. Of course, a lot of that depends on exactly how much this infrastructure negotiation comes to. I mean, right now, Republicans have proposed a little more than $900 billion. And these two things that the White House is highlighting, bolstering the IRS, as well as that 15% minimum corporate rate, those things combined provide more than $900 billion in funding. And so the question, I think, more is for this infrastructure package specifically, can they get to something that pays for the package entirely? And if they can't, are they comfortable passing a package that isn't paid for entirely?
Emily, I got to think that the biggest companies in America will be fighting tooth and nail against a 15% tax floor. I mean, 28% they could deal with no problem, just tons of debt financing, deductions. They buy loopholes in Washington all the time. But a debt floor means they would have to pay that, and they're used to paying some of them less than zero. So aren't lobbyists going to make that impossible?
I mean, look, there are going to be a lot of people with a lot of opinions on this legislative infrastructure proposal, regardless of what the taxes wind up being on this one. So, yeah, you are going to be facing a lot of internal pressure from companies. But the one thing that Democrats will keep pointing to is saying, look, these proposals are popular. Taxing wealthy Americans, taxing corporations, having corporations pay their fair share. When they're polled, it is well above half, if not more, of Democratic voters and in some cases even Republican voters who are supportive of these ideas of taxing corporations. And that's really what the Biden administration is riding on here, that even though corporations might not like it, the people who voted him into power and hopefully will vote him into power again will.
We just spoke with Randall Krosner. He's in London. Of course, the G7 finance ministers are meeting there today, and one of the main topics they'll be talking about is taxation. Do you expect an agreement on a global corporate tax?
It's something that Treasury Secretary Janet Yellen is continuing to push for. It's something that President Biden is certainly hoping for because he thinks that will make his tax plan an easier sell among Americans, potentially among Republicans, among Democrats. So that's something that the Biden administration is very much keeping a close eye on today.
Emily, what would you ask the Secretary of Labor? I'll be speaking with Marty Walsh, and as you know, that cabinet office is a really interesting, and folks, I'll be honest, underestimated, underappreciated office as well. I've got to talk to Martin Walsh about wages. What's your question for the Secretary?
I mean, one of the big things that we're seeing right now with the unemployment numbers really being much lower than expected last month, there was a question that came up. It's like, well, part of the reason that people don't want to go back to work because wages are low. So I'd love to get a better sense of sort of what companies are offering pre-pandemic versus post-pandemic and how much that's factoring into the ability for people to find jobs in the workforce and for companies to rehire individuals.
Absolutely nailed it. It was a topic yesterday, Emily, about the bonuses being paid out in some form or another instead of being folded into the nominal wage. Emily Wilkins, thank you so much in Washington, our government reporter. I think we've got to turn here, folks. On a jobs day, we've got to find little moments here to look at what we all witnessed yesterday. We did speak to Governor Krosner about it. I mean, Taylor, what was it like covering AMC yesterday afternoon?
Oh, I could do this all day long with you, Tom. We cover AMC. We go up 100% on one day. We come down. We took the stage, 2 p.m. We go positive territory. Gina Martin Adams, our guest host, she was the sell signal. AMC turns negative the minute that Gina Martin Adams comes on and starts talking about fundamentals, and we close down. And Tom, it's just unbelievable, the volatility. I think Jeremy Siegel, the professor of Wharton, said it best. Most valuations look good, but what is this signal when you have people out there buying AMC, buying GameStop, who literally say, we don't care about fundamentals? What does that tell you?
I mean, Matt, what do you see here? I mean, we've got to summarize it up. We'll see how AMC trades through the day from a 76 calculus yesterday early morning, about 24 hours ago, and we're down $30 or so from there. I mean, Matt, you know, we make jokes about it, but this is not funny. There's a real question here about the integrity of the bid and ask across the market.
Well, I think to those on Wall Street bets, this is amusing, and this is why they're doing it. You know, they realize that they could lose all of their money, and they're ready to do just that. These bubbles tend to last a few days, and then they move on, typically to pot stocks and then to something else. So you could see Nokia or BlackBerry be the new gainers after this AMC bubble runs
Tom,
out.
I have a BlackBerry. Do you guys know that?
You have a BlackBerry?
A very important BlackBerry with a keyboard.
Unbelievable. The last BlackBerry east of the Mississippi River. We're going to continue on Jobs Day. Jeffrey Rosenberg scheduled to be with us, and I'm thrilled to tell you Carl Riccadonna of Bloomberg Intelligence will be with us next. His thoughts on this Jobs Day on radio and television. Good morning. Good morning, everyone. Bloomberg Surveillance. We welcome all of you worldwide and across the nation. A Jobs Day in America. Taylor Riggs and Matt Miller in for John Ferro and Lisa Abramowicz. I want to get to the data right now and really walk through it. I think it's important to frame where we are. On Monday, on Tuesday, we had a very correlated market, really tight Bloomberg terminal across the screen. That changed yesterday and then into the jobs claims numbers that we saw at 8:30. And what we've got this morning is a better tape. There's no question about that. Taylor Riggs, I would say within the real yield going negative 0.88 to negative 0.82. That's my best indicator of a better jobs report to come.
Yep, 100%. Even though you get the magnetism of Ian Lingen of BMO Capital Markets yesterday talking about the 162, you have to break out either upside above 170 or below a 153. And that payrolls report, Tom, will be the catalyst that drives that move.
Right now, let's go to Carl Riccadonna. Thrilled to bring him in with Bloomberg Intelligence and their chief economist. Carl, really simple here. Your note was wonderfully nuanced about the dynamics right now, and I want to zero in on labor participation. To me, that's the best indicator that we're not back to February of 2020. We're halfway back at best. How long do we take to get back there? Is it a matter of months, or are we looking into 2022 in search of normal?
Well, the May jobs report is going to be critical in that regard because it's going to tell us whether April was a fluke or whether we're actually in a kind of slower growth, slower hiring dynamic. We have a jobs deficit of 8.2 million workers relative to where we were in February of 2020. If we are creating jobs at a pace like we did last month, 260,000 or so, it's going to take about 3 years to absorb that slack. I think most economists are confident that we'll see a faster pace of gains than that, but the notion that we'll be printing 1 million jobs per month and potentially be there by year end or early in 2022 seems to be hitting some difficulties in terms of what we've seen in recent job creation.
I'm going to go academic here with Carl Riccadonna. We can do that out of aerospace in Princeton as well. Carl, I thought Bill Dudley was absolutely brilliant in his essay where he leads off with the way this works is and companies rather have to demand workers. Is there evidence of labor demand or does that await?
Well, there's certainly evidence of labor demand, but there's also plenty of evidence that potential workers are sitting on the sidelines waiting for jobless benefits to expire, waiting for schools to reopen, and waiting for jobs with decent pay and decent benefits, at least relative to what they held prior to the pandemic. So that's a supply-demand dynamic that we have to pay very close attention to. And if we look at the measures of demand, like new layoffs, the initial jobless claims numbers, or jobs plentiful, jobs hard to get, those suggest very robust conditions. But I'm going to be a little bit on the pessimistic side here going into today's number, because if we look at what really matters, the number of people collecting longer-term unemployment benefits, things like continuing claims, they have not budged over the course of the last month to any meaningful degree. And that causes me to have some skepticism that maybe we could see not something as weak as what we saw in April, but something that still has that tone of sluggishness. And last point is, if we look at the hiring surveys, the production manager surveys, whether it's the manufacturing ISM, the services ISM, or these regional surveys out of New York, Philadelphia, et cetera, all of them showed deteriorating labor conditions, a slower pace of hiring over the course of the last month. So I think that potentially the risk here is that we see some endemic sluggishness carrying over from April into May.
Taylor, this beautifully encapsulates a two-part report we're going to see today. All the enthusiasm, the whisper number that Matt Miller talked about is ginormous, and frankly, Riccadonna's got a big number as well. But there's a whole nother current going on underneath this.
100%, and I think, Carl, about what, the 18 or 20 or 25 states, what be it, that are starting to even say that they want to cut back on some of that extra unemployment benefit insurance that you were just talking about. Do we get any clue about the angle that those states start to take this payrolls report?
Well, about half of the states have decided to reduce the federal subsidy or eliminate the federal subsidy for unemployment benefits. The issue is much of that happened just in the last couple of weeks, and so it takes time for those programs to be implemented or phased out, as it may be. And so I believe that maybe this termination of the federal supplement is actually going to have more impact on the June jobs report than on the May jobs report. Also, as we think about the longer term issue here, all of the states will lose that federal match by basically Labor Day of this year. So I think the latter part of the summer, as some of the stimulus fades away, and then post Labor Day, once schools are reopened and the federal supplement is gone, then the real truth will be told as to what's happening in the labor market.
You know, Carl, we're swimming in money here. I mean, the states have $350 billion to spend. We're looking at a $6 trillion budget that, even if it gets worked down a little bit, will still be the highest we've ever had. Why aren't wages rising faster?
Well, it's hard to say what's happening with wages at the moment because we're in the eye of the storm trying to take some very precision measurements, and you'll see those distortions again in average hourly earnings today. We see it in the employment cost index. We see it in unit labor costs in the productivity data. We really have to get past the period, right? The economy is growing about 10% in the current quarter. It probably grows about 10% in the next quarter as well. And so there's all sorts of smoke and distortions and whirlwinds that are They're making it very difficult to get the underlying read, which is why we have to go back to what Richard Clarida said on this program about 2 months ago. He said we have to wait until we're deep into the back half of the year to really get a cleaner read of what's happening in the economy. However, if we assess fundamentals, if we look at slack in the economy, labor slack is ultimately going to be the determinant of wage pressures and more broadly consumer inflation, and that jobs deficit, right? Janet Yellen had her dashboard of many different labor indicators. Jay Powell seems to really have one gauge on his dashboard, and this is the jobs deficit. Until we make substantial improvement on that jobs deficit, then he and the centrists at the Fed are going to have conviction that any inflation pressures we see at the moment are going to be fleeting, transitory, and will moderate as the economy moderates over the next several quarters.
Carl, in the post-pandemic world, do American laborers have the skills needed? One of the problems we're looking at here is this labor crunch isn't just about pay, but it's about the workers that we need aren't skilled in the subjects they need to be.
Well, there are going to be placement issues. If we have the economy growing 10%, placing enough jobs to accommodate that pace of growth is going to be very challenging. But what we saw in the last economic cycle was we were able to train up workers into the skills that were needed for those types of jobs. So I'm always an advocate for more worker training, better education, et cetera. However, what we saw in the last cycle was that employers can kind of help along with the necessary skill set, and you might not need a particular degree to be placed in a job. You just need the relevant job training.
Carl, a final question, and it's almost a Dale Jorgensen question. The application of technology, the jump start in technology, the enhancement of technology that we were forced upon in this pandemic. How does that change this report and the labor economy of the next 12 months?
Well, there's a couple of factors. There's technology, there's globalization, and there's lower unionization rates over the course of the last 40 to 50 years. All of that means that workers have less bargaining power than they historically have, which means we can run the economy hotter without having the inflation consequences than we historically have. So a sense of job insecurity, which will, I think, reemerge as the economy downshifts from 10% growth to something closer to 4% next year and 2% the year after that, is going to reassert. And then, we've seen lots of nice bonuses and benefits and perks as employers are scrambling for workers. But I don't think this is a sustained trend where suddenly workers have more pricing power in the marketplace. And the final point I'll make, Tom, we need to look no further than the recovery from the 82 recession, 1983, 84, 85. We had a similar growth profile in the economy, and it was not inflationary. It did not lead to a significant reacceleration in inflation pressures because there was ample slack in the economy. It's the same dynamic this time around.
In the oddity of the early 80s where we had double recessions back to back of a certain mild character. Carl Riccadonna, thank you so much for the brief with Bloomberg Intelligence, their chief economist, this morning. I'm looking at the markets, and folks, I really want to mention here with the shift that we saw yesterday off better than good ADP, Taylor Riggs, we saw the 2-year yield move out. I mean, there's no question, up from a 0.14 to a positive 0.16, a little bit of a nudge in the 2-year.
And a 5-year yield that migrates northward of about 4 to 5 basis points as well. It's really been the belly of the curve, Matt, that's been the big sticking point here as the Federal Reserve takes a look at all sorts of maybe yield curve control. But Tom mentioned that 2-year yield and 2-year break-evens rising, and they are rising faster than the longer end break-evens.
Matt, the velocity is there, and you see it in euro as well, and yen. A 110 print on yen, and euro really pulls away from the 122, weaker euro over the better job prospects in America.
Yeah, I'm looking into the currency changes here because we've had so many guests on Surveillance Early Edition talking about how the dollar is in a downtrend. But when we see days like this, you have to wait for the data, I know, but it looks like the dollar is ready for a resurgence.
Yeah, well, I don't know if it's about a resurgence, but certainly we've staunched the weak dollar view as well. The other thing, Taylor Riggs, I'd look at is dollar lira. I mean, it's idiosyncratic, it's removed, but it has been a brutal week.
I stole your chart. 3 standard deviations. We blew out into further lira weakness 2 days ago. I think that was, Tom. I stole it directly from you, claimed it as my own.
They're very good. I'm sure you did. The royalty check was sizable. Paid for 1/10 of a beverage of my choice. Turkish lira this morning, 8.70. We saw 8.69 right now. To put that in perspective, a 9 essentially unimaginable weaker lira through the week. Coming up on the pandemic on this Jobs Day, and they are so interlinked. Andrew Pekos joins us with the Johns Hopkins Bloomberg School of Public Health. Futures -3. Dow futures at -60. We quote the Dow for John Ferro. Good morning on radio and TV. It's Jobs Day.
With the First Word News, I'm Ritika Gupta. President Biden hasn't given up on trying to get Republicans on board with his infrastructure proposal. He's raised the possibility of a 15% minimum tax on U.S. corporations, along with tougher IRS enforcement efforts. The White House says the president has not abandoned his goal of raising the headline corporation tax rate from 21% to 28%. He's just setting it aside for now. And President Biden's revamp of Donald Trump's China blacklist leaves room for dialogue. The president signed an amended order naming 59 companies involved in China's defense and surveillance technology sectors. Americans are banned from investing in them. Unlike the previous order, though, it doesn't affect those firms' subsidiaries. That gives both sides an opening for discussion. And big investment banks are having a hard time persuading traders to leave London for jobs in Paris, Frankfurt, and other cities in Europe. When JP Morgan asked a team of about 15 London-based equity derivatives traders to move to Paris, about half of them quit. Because of Brexit, the EU insists that more assets, people, and business must move from London in the coming years. And Apple is trying to keep the momentum going for iPads, whose sales were rejuvenated during the pandemic. Bloomberg's learned the company's working on a new iPad Pro with wireless charging. It's also redesigning the iPad mini for the first time in 6 years. iPad sales soared 79% in the first 3 months of the year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I fully expect that private businesses are going to require vaccine proof, provided their governors don't prevent them from doing that, but that they won't, at some point start requiring vaccine proof to allow people to, go to concerts and things like that. But it is a bit tricky because there are people out there who are hesitant, and their hesitancy is not without reason. This is a new vaccine.
The comment there from Jennifer Nuzzo on the state of this pandemic, and there's no question America celebrates where so many other parts of the world are really having a challenging time. We welcome you to Bloomberg Surveillance on this Jobs Day. A real focus here on the economics. Randall Krosner, Carl Riccadonna with us there. James Glassman of JP Morgan will be here in a bit. Taylor Riggs and Matt Miller in for John Ferro and Lisa Abramowicz as well this morning. Futures -1. Right now on the pandemic, Andrew Pekos. And Andrew, as we wander into June, I want to simply stop and talk about the great unspoken that I see in New York, the great unspoken, I'm sure, in Baltimore, Johns Hopkins, Baltimore as well. And that is the triumph of the pharmacy, the microbiology, and the virology of what America has wrought. Let's begin with how we did it. What did Pfizer and Moderna do in America that allowed them this vaccine excellence?
Well, first and foremost, they paid attention to the basic science, the basic research that was done for 10, 15 years prior to this pandemic, which gave us all the information that we really needed to look at this virus sequence when it first emerged and say, you know what? There are papers out there that tell us exactly how to make this vaccine. This looks exactly like what we've done before for this variant of coronavirus. And we moved forward then with lightning speed with the help of government that allowed to sort of cut through some of the red tape and move past some of the things that were slowing things down, but still allowed us to move forward in an efficient way, maintaining vaccine safety and maintaining ideas about efficacy as well.
Dr. Pekos, I'm going to suggest you and others have failed here, like the Baltimore Orioles in the beginning of the baseball season. When I look at the CDC report on mRNA vaccines, and let me quote, "The vaccine does not contain any virus, so it cannot give you COVID-19. It cannot change your DNA in any way." We've done a lousy job of selling that idea to people who are non-science and afraid. How do we change that?
Well, you know, I think the biggest issue is the communication that happens via social network mechanisms that really allows for things that are inflammatory, things that seem more challenging, things that seem more dangerous, but are yet not fact-based, to really spread like wildfire. And that is the hardest thing to sort of do. Historically, I've been looking back at some of the other years of vaccine hesitancy and with polio vaccines, and even going back to Robert Jenner and the smallpox vaccinations. There were people during that period of time that were incredibly anti-vaccine, even though smallpox was a disease that was horrific in terms of the damage that it was inducing in the population. So the social media outlets have just allowed these messages to be amplified much, much faster, and we're always impressed, or at least there's an impression that's made when we send these messages of things that could potentially be problematic or harmful. So it's a massive problem that moves away from the science and really into the communication fields and how to do that communication more effectively.
Speaking of communication, we are 30 days away from a self-imposed July 4th deadline. Where are we on the path to getting 50, 70, 80% inoculations, and can we all get free beer from it?
I love the idea of getting free beer for vaccination. Unfortunately, I got my vaccination before those incentives were out there. I think that we've slowed a lot in the past month to 2 months. We saw a massive surge. We got to 50% of the population getting vaccinated in an incredibly fast rate. We got our kids vaccinated when that became available at a very fast rate, but now we're seeing us settle into a level that personally I find underwhelming. We really need to push past the 70% guideline that has been set now by the government. I've always viewed that as a minimum. And what I mean by that is you reach that 70% and you'll have a massive effect on severe disease and hospitalization because you've immunized those sensitive populations. But if you want to get to the concept of herd immunity, where everybody, including the unvaccinated people in the population, are benefiting from people who get the vaccine, you have to push past that 70% level. Otherwise, we're setting ourselves up where we have a country with two populations. Well, we have two populations now. The infection rate
Andy, what's the danger? What's the danger to the vaccinated of the unvaccinated?
The most important danger is the unvaccinated. The infection rates in the unvaccinated populations are much, much higher than the rate that we're reporting for the population because there's a divergence there. Vaccinated people are getting infected at an incredibly low rate. Unvaccinated people are still getting infected at a high rate. And every time you have populations that are unvaccinated, you're giving this virus a chance to evolve, to select for variants that'll be able to avoid the immune response or perhaps be better able to transmit. And so if we let this virus fester in the population, we're sure to see variants emerge that are better at infecting both vaccinated as well as unvaccinated people.
Dr. Peckhouse, thank you so much. And just congratulations to Johns Hopkins with their part of the work, the effort in this pandemic. He's with the Bloomberg School of Public Health. And of course, Michael Bloomberg, philanthropist, is the principal of this television and radio network as well. Futures -1. It's a really stasis here with the VIX 18.15. Matt, we were talking about the foreign exchange market with DXY a little bit stronger. Matt, we have an ECB meeting upon us next week, don't we?
Yeah, absolutely. And it looks like, as of now, that they're going to continue with their ramped up asset purchase program, at least through the summer. Of course, over here, you have a lot more sort of natural dovishness than you do over there. But, you know, the ECB has been talking about tapering much longer than the Fed has been talking about tapering.
I mean, what I read, Matt, is that Europe is very regional, very city to city. Is Berlin this weekend locked down?
Berlin is actually opening up this weekend for the first time completely. I mean, we've had outdoor dining for the last couple of weeks, but starting today, and I've got a reservation at the local Brew Dog, we're going to be able to go in restaurants, we're going to be able to go in movie theaters, we're going to be able to go in gyms, gymnasiums, workout places.
You're going to be ordering a Budweiser, no doubt.
I will be getting the Clockwork Tangerine.
You can get free popcorn at an AMC movie theater, Matt. Free popcorn.
We could get only one, though. Only one. I usually eat 2 or 3 during the course of a film.
Matt Miller, thank you for your support this week. Greatly appreciated. On this Jobs Day, I'll advance forward with Taylor Riggs. Romaine Bostick, I believe, is off the Sikorsky and will join us here in a bit. We start strong in the hour. Priya Misra will join us with TD Securities, the litmus paper of the American financial system on fixed income, on full faith and credit this Jobs Day. Looking forward to speaking to her. Stay with us. This is Bloomberg.
The Fed needs to stop fixing to do something and actually do something.
It's hard to have much of an inflation problem if wages are still quite quiescent.
Since the pandemic, my argument is the Fed is changing policy.
Regardless of what the Fed does or does not do, the U.S. economy is going to grow somewhere 6, 7, 8% this year.
2022 is going to be a year of deceleration. The economy is going to be strong, but it's going to be growing slower.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene, a simulcast, Bloomberg Radio and Bloomberg Television. A Jobs Day after the humbling that we saw 30 days ago. Every economist missed the mark. Helping us out this morning, John off, Lisa off, Romaine Bostick with us as well with Taylor Riggs. And we say good morning to all of you on Jobs Day. Taylor, what I see here in the real shift off of yesterday's data is non-farm payrolls moving out nicely. And Matt Miller earlier with a whisper number of the 800,000 level.
And we're getting Ellen Zentner at around 650. We had Michael Gapin and Barclays yesterday around a 675. I think, Tom, what makes me sort of chuckle, if I'm allowed to do that, is one of my favorite research notes said...
So. Chuckling on this show?
There is chuckling at 7 a.m. The sensitivity of those inputs means that you tweak one little thing, you get 0 jobs or 1 million. Your guess is as good as mine.
Give that woman a Tang mimosa. On radio and television this morning, what you need to know is, yes, we'll be doing a lot of economics with Ms. Zentner. I thought her note yesterday, really interesting. James Glassman of J.P. Morgan with a pulse of this nation's labor economy. But Romaine Bostick, the market shifted yesterday off of claims at 8:30. To me, there was no question about it. You saw dollars stronger, and the real yield, Romaine Bostick, moved.
Yeah, it actually did move. And look, this has been the talk for quite some time now. We've seen a market that's kind of been moving sideways for the last 5-6 weeks or so. They've really been waiting for a little bit more clarity about the economic picture and, more importantly, what the reaction function by the Fed is going to be. Maybe today we get a little bit more clarity out of that monthly number. The weekly number definitely shows a trend that seems to be fitting with what the Fed has been telling us now for quite some time.
Let's set it up with a data check. Not as good as Karen Moscow on Bloomberg Radio worldwide, but Romaine and I will struggle to be on the edge of Moscow. Red and green on the screen. I see futures up 1. Not much going on there. Center tendency on VIX 18.04. The Dow 35,000 is at 34,540 as well. Romaine, let me frame oil, and I'll give you the rest. Brent crude rounded up $72 a barrel, and NYMEX 69. To me, this is not a small issue, Romaine. We've really seen oil persist here at the $70 level.
It's really persisted here. Remember, we got a big catalyst potentially next week with the resumption of those Iran talks. It'll be interesting to see if a deal is struck, and whether the return of Iran to the legitimate market here causes a little bit more price pressure to the downside.
Look at the fixed income market, Romaine. I mean, I mentioned the 2-year yield is frankly, it's adjusted a little bit, to say the least, 0.16%. But the 10-year yield, Romaine, your thoughts?
Yeah, I mean, we've been camped out right around that 162 basis point level for quite some time. And magnetism, as Taylor would say. Look, we haven't made a meaningful move above 1.7 for quite some time. We haven't made a meaningful move below that as well. But a lot of folks now saying that, look, once we start to get a little bit more clarity on this economic data, 1.8, 1.9 is certainly realistic sometime this year.
We need a brief. Taylor Riggs.
Let's do it. Let's talk about the magnetism of an 8:30 a.m. U.S. payrolls report. That's pretty much the only thing that we're really going to be focusing on here. We're going to count us down from 8:30, and then we'll take you up into the open at 9 a.m. I will be doing that, Tom. So, of course, that will be wage growth and, of course, the non-farm payrolls that are the key headline numbers. We push forward to your interview, Tom, 9:55 a.m. I share the 2 minutes of the open with you as you interview our U.S. Labor Secretary, Marty Walsh, of course, as we know him from Boston. That interview will be coming up. And then finally, 10:15, we're going to hear from the president on that jobs report. So we'll have to get some comments, of course. If it's good, what does that mean? If it's bad, what does that mean? We certainly think that the Fed will remain on pause despite any of the numbers that we continue to get this morning.
Well, certainly the president with a bombshell yesterday of moving corporate tax in the vicinity of 15% for the GOP. Somehow I think he'll fold that into the conversation. Again, we've got wonderful conversation coming up on the mystery of 30 days ago, the shock to the markets, and where we are now, and of course, forward. Priya Misra joins us now with TD Securities Global Head of Rate Strategy. Priya, I've really been looking forward to this on the nuance of full faith and credit. What have you seen in inflation-type securities in the last number of days?
Thanks, Tom. It's been the most interesting part because, as I think Romaine was saying, the 10 years been camped out 160, 170, 150, 160, but it's really these inflation tips or inflation-protected securities. They've been going up in price, so I guess lower in yield. They've been pricing in higher inflation expectations, and what that's done is it's taken real rates significantly lower. I actually think the market's a little too complacent about the Fed not even talking about tapering. And if that happens, so if today's number is actually solid, we get another good CPI number, I think the Fed starts to talk about tapering potentially as early as the June meeting, but more likely in the September meeting. That's when those real rates need to rise. So I think inflation expectations are well priced. It's that real rate component that seems to be very low given all the supply that we have to take down auction after auction. We've got 3 auctions next week as well.
If the Fed does indeed start to talk about tapering, if there is some more positive news, as you mentioned, later this summer, where would that show up? Where are the markets being too complacent?
I think it's really the belly of the curve, the 5 to 10 year sector, because the very long end has demand from pensions, has demand from the Japanese lifers. The very front end is anchored by the Fed that's not likely to hike anytime soon. But it's really that 5 to 10 year. We have a ton of supply coming in. There's no natural buyer. I am looking at fixed income inflows. If they start to slow down, because as people realize, well, there is something called duration risk. We haven't had to deal with it for a very long time. But as duration risk starts to show up in portfolios, it's really that belly of the curve that I worry about.
Well, we talk about sort of what the Fed reaction is going to be here. A lot of people are focused on those inflation numbers. They're also sort of focused on, I guess, some of these secondary employment numbers. The idea that Powell and the rest of the Fed have made it clear that they want to address some of the inequities in the economic recovery and try not to repeat some of the mistakes that were made coming out of the financial crisis here. How do you model that when you're trying to sort of get a sense here of when the Fed will move and how aggressively they may move?
Right. Great question. So that's a reaction function around the first hike. So this is why I do think that this reaction function is much easier. So they want an inclusive labor recovery. I think this is not just talk. I think they actually believe it. And they want inflation to overshoot. So I think what will happen is when we start to price in tapering, but I have to say that the tapering bar is not that high. You need substantial further progress. We could potentially make that by the end of the year. I think what could happen is that as the 5-year starts to rise, it could actually take the front end with it. So I think there'll be an opportunity to push back against market thinking that the Fed might hike next year, but the tapering threshold could come much sooner than that.
Priya, let's go back to first principles here on Jobs Day, which is to frame the 10-year yield. If we call it, well, we've had a move, and now there's legitimate stasis. Is your vision out, as we heard from a guest yesterday, to a 185, or is your vision out to 2 or higher? Describe that path.
So in the near term, because we actually have a slightly weaker labor report, we also expect inflation to largely be high only because of COVID-impacted areas. We actually think the June FOMC will still be dovish. So in the very near term, I've got a 175 forecast. By year end, we do think that the Fed will start to signal imminent tapering. That's when I am forecasting the 10-year to reach as high as 2%, driven by real rates. And that will bring investors from risk assets, from other areas. So, I think there will be buyers, but not at 185. I think if the Fed is stepping away and we have all the supply to take down, I think real rates will need to rise to take the nominal 10-year to 2% to bring buyers in.
Okay, you talk about bringing in buyers from other asset classes. What is that level on the 10-year yield where it indeed does start to rival, let's say, a dividend yield?
Well, I mean, it also depends on, are people revising their dividend yield forecast? I think, we know that this year growth is very good. It's been the best in decades. What is growth like next year? So our forecast for growth actually next year is lower. We're going to be dealing with fiscal drag. The reopening impacts will go away. So do investors start to reduce some of their risk asset returns as well? And then, maybe real rates at 50 basis points on the 10-year or 0 on the 10-year will start to look attractive. So between that 2.5 on the 10-year, I think is equilibrium. So if, the Fed is sort of fully priced in, I think that's the level where you do bring buyers in. For the safety, I mean, treasuries give you safety as well as liquidity. So there's some role of that in any portfolio, I would argue.
Priya Misra, thank you so much for getting started in this hour. Priya Misra with TD Securities here, in the yield in the 10-year to 4 digits, 1.6215. It'll be fascinating. It's Taylor Riggs mentioned there to see where the short-term space moves as well. Much going on a Friday worldwide. The Bank of International Settlements does what they do best. It's the central bank for central bankers, or I should say the central banker for central banks. That's right. They have gathered together the great and the good on climate change in this interesting idea of what central bankers can do there. Gillian Tett of the Financial Times leading a discussion with Christine Lagarde and Jerome Powell, Augustin Carstens, among others. I believe Governor Bailey there as well. But this is a real set of worthies trying to figure out how economics and particularly monetary dynamics folds in to better GDP and sustain GDP among climate change. And Taylor Riggs, it's a different effort than the Paris Accord, which really went to the documentation of data coming off of cities and smaller institutions.
And I have to say, it was Larry Fink of BlackRock, I think last week, Romaine, talking about the higher inflationary trends as we shift to going EV, to going green. We don't have the technology yet. So there is that inflationary aspect in that pivot before you get the rest of the technology deflationary trends that we've seen in the last few years.
Yeah, and the way that central bankers are embracing this as a policy measure, not only coming out of the Europeans and the Americans, but of course you're also hearing Yi Yang over in China making similar comments as well. So this is a push, a global push right now by our monetary policymakers into that arena.
It really is. And again, this is what BIS does well. I can't say enough about the institution. As one of our guests mentioned the other day, they are absolutely definitive on thinking through this event called Bitcoin. Let me do a quote. Romaine Bostick insists I quote on Jobs Day. Bitcoin, 36,800. Stay with us. We have not mentioned AMC in at least 12 minutes. We'll fix that problem when we return. Savita Subramanian on the equity markets coming up. Good morning.
With the First Word News, I'm Rishka Gupta. Traders are waiting to see what the U.S. jobs number is like. The May unemployment report is out at 8:30 New York time. According to a Bloomberg survey, the economy created 674,000 jobs last month. Economists had forecast a big number for April. Instead, employers added just 266,000 jobs. British companies are on a hiring spree. They're employing permanent staff at the fastest pace in 23 years and advertising the most vacancies in 3 years. The number come from consultant KPMG, an online job placement agency, Adzuna. They add to evidence that the British economy is bouncing back after last year's recession. President Biden is turning to taxes as a way to get a compromise agreement on infrastructure. The president has pitched Republicans the idea of a 15% minimum tax on U.S. corporations. For now, the president is setting aside his proposal to raise the corporate tax rate from 21% to 28%. European Union regulators have opened a formal investigation into Facebook. They want to know if the social network violated competition rules by using data gathered from advertisers to compete against them in classified ads. Facebook says it will cooperate with the investigations to show that they are without merit. And Vivendi is in talks to sell 10% of Universal Music Group to a blank check firm backed by billionaire Bill Ackman. A deal would value the world's largest music company at more than $42 billion, including debt. Vivendi plans to spin off most of UMG later this year and list it in Amsterdam. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What the economy really needs right now is a way to help people adapt. And that's support for the jobs of the future, for the businesses of the future. And it's very different than the kinds of plans that President Biden is proposing. Unfortunately, the opposition is not proposing much either, but it really be about jobs and the future.
Glenn Hubbard there. Really thrilled to have him on yesterday with Bill Dudley. To have Hubbard and Dudley on, I think, really speaks volumes about our booking team here at Bloomberg Surveillance, trying to give you smart voices. We do better this morning. Taylor Riggs and Romaine Bostic in for John Ferro and Lisa Abramowicz and Lisa Abramowicz. I nailed
there you
that.
Go.
Joining us now, Josh Wingrove after Dudley and Hubbard, and he's on the lawn of the White House this morning, our White House correspondent. Josh, I think Ian Duncan in the Washington Post had it beautiful. It was a photographic image of the gentleman from Oregon, Peter DeFazio. And he is the personification of what the Democrats face. He won like 110% of the vote in the 90s in his Oregon, Corvallis, Eugene, Oregon district. And last time around, he barely won because of the coming on of the Republican Party. How does that dynamic fold into this infrastructure and transportation debate? These Democrats that aren't from big urban areas, these Democrats who are scared.
Those endangered Democrats, yes, in Congress, absolutely. And, he's been one of the advocates for infrastructure. I think the backdrop here is that Democrats believe that their path to, winning or holding on to things in the midterms is simply to get things done. And regardless of whether that will actually deliver in the midterms or not, they figure they might as well get things done because the alternative is they lose and they won't be able to get much done at all. And so we've seen Joe Biden continue to negotiate. He's going to talk to Senator Capito today. Maybe we'll get a little bit of an update today, but I wouldn't bank on, a deal today.
But the answer is his action yesterday, the President of the United States, was an action for the Democrat from Oregon, not a given Democrat from New York or Washington, the liberal wing of the party. Are they just out of the picture now?
Well, I wouldn't say that. I mean, this president, for instance, stepped in it a bit this week when he took a swipe at an implied swipe, at least at Joe Manchin and Kyrsten Sinema. Those are same type of endangered, sort of moderate Democrats. Biden is trying to hold together the coalition, right? I mean, the progressives were very skeptical about Joe Biden when he became the nominee. They were skeptical about him when he became president. So far, they've been, more or less okay. This infrastructure package, though, I think is a bit of a crossroads there. In particular, what is he willing to sort of take off the table to get a deal with Republicans if there is a deal to be had? And I think a lot of Democrats remain very skeptical about whether that's the case. And then he's going to turn around and maybe try to do something with Democrat-only votes, but then he's going to run into the wall of Joe Manchin, as I mentioned, and we'll see where that goes. But yeah, Biden is trying to hold together the coalition. But you're right. This is a Democratic Party that is torn between the progressive wing, the more urban wing, and other members who are sort of scattered in different districts who are saying, hey, don't forget about the rest of us.
Yeah, well, so in addition to sort of keeping that coalition together, there's obviously the big question here about some of the tax policies that he's been promoting, both in terms of the specific ones here for the U.S., but of course, we also know that Yellen is on her way or over there for the G7 summit and is going to be sort of pitching what would effectively be a minimum floor here globally. Now, whether the rest of the world will go along with that remains to be seen. How much of that can actually work in Biden's favor with regards to what he's trying to negotiate in Congress? If they do sort of move a little bit more away from that corporate tax rate that was first floated out there and to some sort of a minimum tax that every nation, at least the developed nations, would embrace.
Yeah, I think that this is something that he's dangled out there for Republicans this week. Our colleague Justin Sink and others reporting this. He said, look, what about instead of 28% with all the various write-offs you can get against that, why don't we do sort of a floor? And, he's taking aim at Amazon and others, big mega companies that have paid little or nothing in federal taxes recently because of all the ways they're able to sort of minimize their tax bill. So, Republicans, I think, are going to be cool to this idea, but they might have a, crossroads here. Are they willing, would they rather a 15% floor than Biden, pick up his toys and go home and just try to ram something through with whatever they're able to ram through under parliamentary rules with Democrat votes only? I think that, broadly speaking, Biden borrows from Trumpism, when he can, when he's willing to. And one thing is this sort of almost populist lunch pail pro-worker message, and he's been very willing to take a bit of a hammer to corporations for stock buybacks, for excessive CEO pay, and for not, in his view, paying enough in taxes.
Where does the conversation stand, Josh, on debt and deficits? We were speaking with Randy Krosner over at the Chicago Booth School. He's a professor there, saying that there's no amount of increased taxes that can help push off the rising debt and deficits. You have to start to bring in the private sector. Has the White House looked at bringing in the private sector?
They haven't talked about that publicly, but when you ask what the conversation is around debt and deficits, there almost isn't any in Washington to say the truth. I mean, Joe Biden's budget that he proposed, only in 2030. So after Joe Biden could still conceivably even be president, would his measures begin shrinking the deficit rather than expanding it, let alone, closing it back to a zero deficit scenario? So deficits seem to be the reality of it. Biden has, though, on the flip side, argued that he doesn't like deficits in order to support his tax hikes. In other words, saying we can't just deficit finance everything. We need to pair infrastructure spending with tax increases, whether the corporate tax or otherwise. So on the one hand, he's saying, I don't like deficits. On the other hand, his budget sees them as far as the eye can see.
Josh, thanks so much. Josh Ringove, a brief from the White House, our White House correspondent on this Jobs Day. We've got lots to talk about on jobs, on economics, some good guests coming up. But certainly, Romaine Bostick, we have to turn to AMC and what we just simply continue to see. Is a short squeeze over from where you sit, Romaine?
Yeah.
Is the fireworks done?
Yeah, well, I think the short squeeze was over a while ago. I mean, when you look at the volume and more importantly, the amount of money that's been swapping hands here, I mean, this is really less about the short squeeze and more really about, I don't know if you want to call them true believers or what, but people sort of jumping into this stock, despite the fact that the trend line has been down the past couple of days. But like I said, there's been no lack of ability to sell your shares. So usually when we have a short squeeze, you can't sell, and that's what sort of pushes the prices up. The volume is still high. It's been just as high as it has ever been over the last few days here, yet we continue to see it drift lower. It's lower here in the pre-market, and of course the company seemingly going to take advantage of this again by putting more shares out there, but not till next year.
What will the traders look for today? I mean, into a weekend, is that a big deal, Romaine?
I think for the types of traders that are in this, I'm not sure that is a big deal. The question, and we talked about this yesterday, is if you believe there is a true fundamental rebound story here, then maybe you stay camped out of this at $48 or whatever it is right now. I think most analysts, at least the sell-side analysts you talk to on the street, will say the fundamentals really don't match up right now, align right now with the price.
Tom, if you want to trade on weekend, just go into Bitcoin. It's open. It doesn't close.
Yeah, I noticed that. I mean, it has its own life of its own on the weekend, maybe based off Mr. Musk's tweets or that 37,000.
I hear there's a breakup
on Bitcoin. I mean, we'll just have to see. Right now, we are focused on the jobs report Lots to talk about here. And of course, we'll go beneath the headline data here in exactly 1 hour. What am I looking at? I'm looking at labor participation. To me, that's the heart of the matter. We are distant from where we were Valentine's Day of 2020. Coming up, Ellen Zentner of Morgan Stanley. Stay with us on television, on radio. Good morning. Bloomberg Surveillance. Good morning, everyone. It is Jobs Day. We welcome all of you around the world, across America. It is a humbled set of economists that will address the data in exactly 1 hour. Last month, without question in my career, the biggest miss ever. Granted, some moving parts, a lot of which has been rationalized, and we'll go rational at 8:30 with the data and then move on there to good analysis. I'll be speaking with Martin Walsh of the Biden administration here in the vicinity of 9:55 this morning. Taylor Riggs with me this morning, and also Romaine Bostick. Romaine, do you go with AMC or do you start with something a little bit removed?
Well, let's start with AMC. I mean, it continues to be the biggest mover out there, pre-market, even in the cash market. Once again today, unfortunately, the trend line for the last couple of days has been down. You can see it down here, about 5% here in the pre-market. Another potential share sale coming down the pike here. The CEO making it clear here, they're going to take advantage of this recent elevated price action in order to sort of get its balance sheet right here. Whether investors want to ride that out remains to be seen. Also, keep an eye on Pershing Square. This is the big SPAC here. Of course, ticker PSTH, Bill Ackman SPAC, the biggest SPAC ever raised here. Remember, last July, they raised about $4 billion. Apparently, in talks to strike a deal to buy 10% of Universal Music Group. So Billie Eilish and Bill Ackman maybe will be breaking bed down the street at some point. Keep an eye on the crypto stocks as well. Coinbase lower here. Another cryptic tweet by Mr. Musk here, enough to take down cryptocurrencies as well as a lot of the stocks related to that. I wanted to flip up the board because we've been talking a lot about AMC and these meme stocks and everything else, but there are a lot of stocks with real fundamental value here that have been rallying. Look at Ford here. That's up 3.5% on the day. What if I told you this is actually one of the best performing stocks of the year? It's up more than 80% year to date right now. A lot of enthusiasm coming into this company and its EV strategy. That is apparently going to continue. And believe it or not here, there is a fundamental story that says 1655 might actually be low. Remember, their post global financial crisis high is around that $19 level. A lot of strategists and analysts think that it can get back to that. Facebook under pressure here. The EU finally moving forward here with that investigation into some of the company's competitive practices. That's putting a little bit of pressure here on the shares. And then finally, take a look at Wells Fargo. Interesting upgrade today over at the folks over at Bank of America here. Basically, this is primarily a valuation call, but the company really saying that when you compare this company to the rest of its peers out there, it's really priced well below where it needs to be. A lot of people now starting to jump back on the Wells Fargo train, of course, after jumping off a couple years ago when they were dealing with all those.
And I'd even note that some of the growthy guys climbing on board the cyclical value sustained trade. Ben Laidler, eToro, Romaine really reaffirming what you show there with those stocks today. On radio and television, Bloomberg Surveillance now, less than 1 hour to the jobs report. We continue our coverage here. Romaine Bostick and Taylor Riggs in for John Ferro and Lisa Abramowicz, and joining us, Zentner of Morgan Stanley. Ellen Zentner, I first came to your note when I noticed your wonderful work on consumption. We all see that consumption, the consumer rather, has been a goods-producing consumption. When do we shift over to service sector doing better than good?
So we're seeing service sector spending pick up. It's still lagging behind the share of spending that was taken by durable goods and non-durable goods starting last year. But services, obviously, as we get more comfortable with moving out and about, and capacity is now open in just about 49 of the 50 states, not fully, but a good deal of the way, then services spending will continue to pick up. I mean, I think what I like to see in our consumer surveys is that the preference for experiences over things has not changed. COVID did not change that. We just weren't able to experience all of those wonderful things that create memories until now. So we will continue to ramp up and catch up. And I think over the course of the year, we'll see the share of consumer spending devoted to services move back toward its pre-COVID level.
Right. Ellen, across your career, we've always seen the Zentner humility meter. It spiked 30 days ago. I mean, that was really something to see so many people get this natural disaster in our labor dynamics wrong. Are we setting ourselves up for another humbling moment here in an hour?
Well, I think if we look at consensus and our own expectation around 650,000, it's sort of middle ground. It says that we're all saying that April was a one-off, that we're not going to get that kind of weak jobs print again. But whereas we were expecting over 1 million jobs in April, we're not saying that we suddenly expect that in May. So I could say that there's downside risk if the frictions that were keeping people from going back to work in April were still just as prevalent in May. And we certainly see the business reports, anecdotal reports of missing workers and having to pay up for workers is still quite prevalent, has only risen. But you could also say that there's upside because there were a lot of positive things in the employment data last month that just didn't quite get captured. I think what we should do is be surprised, expect to be surprised.
Given the wage dynamics you just described, what are the key drivers for what you see as a decline in earnings and a decline in the average work week?
So it's a good question, Taylor. So there are a few different metrics that we follow for gauging wages. Average hourly earnings is probably the worst one of those, but unfortunately that's in this payroll report. And so the markets follow it and we have to follow it. So when we are bringing back low wage workers, and that's the bulk of the jobs that we're creating because that's the bulk of the jobs that we lost. The more we bring back those workers, the more it depresses wage gains because there's a mix effect here. And so they're dragging down the average. And so average weekly hours is actually a great metric. And that tells us that part-time we're starting to add more hours to the work week or that we're bringing back more full-time workers. So we want to see that move up. Average hourly earnings right now is so volatile and marred by all the comparisons to last year and distortion. So I would sort of put that aside and just focus on the Fed's preferred measure, the employment cost index, but we don't get another reading on that until July.
Speaking of the Fed, push us forward to June, July, the rest of the summer into the fall. Is wage inflation the type of good inflation that the Fed likes?
So it's a deep debate within the FOMC and with the economist community. So there are two different kinds, right? You could have higher wages that lead to a wage price spiral. That would be sort of 1970s style. And we haven't seen that in a very long time. Or you could have wage increases because prices have been rising and workers go in and demand more wages. Now that's more of what we're seeing today, and that tends to be more durable. And I think that's what the Fed has to wrap their heads around. We're seeing wage pressures because prices are increasing, and the reservation wage, the minimum wage at which a worker is willing to take to go back to work, has been rising. And the interesting thing is, it's risen the most for the lowest income groups, which makes sense because we have a tight labor market there because people are not willing to go back to work.
Yeah.
But it's also rising across the high wage and middle wage paying industries as well. So this is something the Fed really needs to watch. We think these wage pressures are more sticky, and that means households are more price tolerant, and there's even more chance for businesses to pass on those price increases that become more durable.
With regards to the willingness of some of those folks to go back to work, and you look at the ratio of unemployed to the number of job openings, how much of that is being distorted or being driven right now by some of the fiscal policy measures and fiscal policy proposals out there?
So, Romaine, that's probably the second most debated thing within the Fed. So I can point to at least 6 different studies out there, good academic studies, that say, yes, the generous unemployment benefits are having an effect, and those that say, nope, we don't find that they're having an effect, or that they're having an effect, but it's no greater than health concerns and transportation issues and childcare issues. And the Fed's Beige Book released yesterday, which gauges conditions across all of the Federal Reserve districts, had 44 mentions of unemployment benefits keeping people from work. But then the other districts said, no, it's similar to transportation, childcare, and other issues as well. What we do know is that people will get more comfortable coming back to work, but they're demanding more wages to do it. And what we will do is the 24 states that have now decided to stop these benefits early starting starting next week all the way through July, we'll start to watch the state by state data to see if that's really having an effect.
So, Ellen, I mean, one of the sort of big divergences in opinion I hear from portfolio managers and market strategists is trying to pin where we are in the economic cycle. As an economist, where do you think we are right now in that economic cycle?
So I think we're much further along than people suspect. So the simplest argument I can make is this may not be a new cycle. This may be, we're picking up where we left off in the last cycle, except we've got $5 trillion of stimulus behind us. If I look at all the deleveraging that normally goes on in downturns, there was none. If I look at the concerns around within certain segments of corporate credit that we were concerned about late cycle in the last cycle, that's still the concern today. Except you have easy monetary policy and fiscal stimulus behind it. And so I think, we're seeing the inflation pressures that we would normally see mid-cycle, and we've not needed to deleverage the household balance sheet. I mean, there's every reason to believe that we should assume that we are mid-cycle and conduct ourselves accordingly.
Ellen Zentner, thank you so much with Morgan Stanley. Greatly appreciate this and your follow-up after the jobs report at 8:30 as well. Taylor, I look at the dynamics right now in the economic space and how it'll fold into the market. And after the humbling 30 days ago, you just wonder where we'll be at 9:30 when we open.
Dan Curtis sent out a really great chart showing that the markets love those big misses because it means that is more uncertainty, more data points that we need, and that there's further uncertainty about how the Fed will and when they will react. So the market's certainly enjoying perhaps the big surprise that some of the economists maybe not so much.
Romaine, where are we on big tech right now? Julian,
we're nowhere.
We're nowhere, right? Big tech's not happening.
No, I mean, I think a lot of people have at least forgotten about it for the time being. They'll probably re-embrace it, I'm sure. But when you look at all of the big names, whether you're talking about your Apples, Microsofts, all of them, really, I mean, you're talking about all-time highs that were hit for a lot of these companies all the way back in January and early February, and they really haven't been even close to them ever since. I think a lot of people have been focused on maybe some of the more momentum stocks, if you will, for a lack of a better term, Tom. But we cover this all the time. As you know, Taylor and I host another show. It's called The Close. Yeah, absolutely.
It's his favorite
we are
show.
here wire to wire, Tom. We were told you needed help this morning.
Well, it's
so
a
we're
long
here.
day. Yeah.
Absolutely.
We do.
Yeah,
John
that's what we're here
Ferro
for.
out and Lisa Abramowicz as well. Thrilled that you're with us this morning.
You should come co-host The
8:30.
Close with us, Mike.
Oh, I should come. So that's in the middle of a surveillance nap, as we call it. I do want to mention Julian Robertson out in the zeitgeist with Tiger Investment. He still likes the technology stocks of profitability as well. It's a shameless plug. The Close, 2 p.m. Stay with us on radio, on TV. The Jobs Report in 50 minutes. Good morning.
With the First Word News, I'm Rishka Gupta. President Biden hasn't given up on trying to get Republicans on board with his infrastructure proposal. He's raised the possibility of a 15% minimum tax on U.S. corporations, along with tougher IRS enforcement efforts. The White House says the president has not abandoned his goal of raising the headline corporate tax rate from 21% to 28%. He's just setting it aside for now. President Biden's revamp of Donald Trump's China blacklist leaves room for dialogue. The president signed an amended order naming 59 companies involved in China's defense and surveillance technology sectors. Americans are banned from investing in them. Unlike the previous order, though, it doesn't affect those firms' subsidiaries. That gives both sides an opening for discussion. And Apple is trying to keep the momentum going for iPads, whose sales were rejuvenated during the pandemic. Bloomberg's learned the company is working on a new iPad Pro with wireless charging. It's also redesigning the iPad mini for the first time in 6 years. iPad sales soared 79% in the first 3 months of the year. And shares of AMC trading lower. Yesterday, shares on another wild ride. The money-losing movie theater chain first lost 40% of its market value, then regained more than half of that. At the same time, AMC raised more than $587 million by selling new stock. And Bitcoin fell after a tweet from Elon Musk, apparently hinting at a potential split with the largest cryptocurrency. It dropped more than 5% at one point to trade under $37,000. In his tweet, Musk wrote #Bitcoin with a broken heart emoji and referred to a Linkin Park song about a breakup. It's the latest post from the billionaire to roil Bitcoin's price. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Rishka Gupta. This is Bloomberg.
integrity of the markets is crucial, and we've seen a lot of newcomers into markets, and we've seen a lot of coordination of those newcomers in markets in ways that we hadn't seen before, people using technology. So regulators need to be aware of that, and market participants need to be aware of that. Greater volatility.
Randall Krasner, the former governor of the Federal Reserve System, starting strong this morning with the Booth School in Chicago. It's been a really good series of guests here on the moment at hand. It is Jobs Day. It is about the dynamics of the labor economy, but it's also about much more. It's about the linkage here into the financial system. We've all been distracted by whatever it is, the new GameStop, AMC, AME, whatever it is. Romaine Bostic with us. And Taylor Riggs this morning. Ferro and Lisa Abramowicz have to be off. Right now, David Wilson with a bar chart ready for radio, and it's about those Dow components to be.
Well, not
going to be Dow components?
I wouldn't go that far, Tom. But, it's Russell Reconstitution Month in June. The Russell indexes get a once-a-year overhaul.
The 1,000, 2,000, 3,000.
All the rest, absolutely. And we actually get preliminary lists of the companies that'll be in each index today. The process plays out over the next 3 weeks. And then on June 28th, before the opening bell, it's a Monday, we get the newly reconstituted indexes.
And if you get bigger, you're tossed out, right?
That's sort of how it works for the Russell 2000, and it's going to be especially noteworthy this year given the rise of AMC Entertainment and GameStop. I ran the numbers on the Bloomberg terminal, found out that those two companies account for 7.5% of the Russell's gain this year between them. And bear in mind, we are talking about an index which actually has more than 2,000 stocks at the moment, according to our data. So 2 stocks out of 2,000.
Let's cut to the chase. If somebody's listened to their financial advisor and they've bought passive funds, including a Russell 2000 fund, they own these stocks.
Absolutely. And they won't own these stocks a little more than 3 weeks from now. That's the thing. It's all going to change. I did a list of the top 10 influences on the Russell 2000. That's what the chart shows. And every one of them, as it turns out, has a market value that's high enough that the companies would be promoted to the Russell 1000. And certainly that's the case with AMC and GameStop. So what your index is now is not going to be what it is come the end of the month.
Dave, I'm still trying to teach Romaine the difference between mean and median. Where are the market caps relative to the median in the Russell 2000?
Well, that's an easy one, median versus mean, at least for someone who's been doing charts for years. And both AMC and GameStop are well above the median for the Russell 1000. You see the numbers there. $15 billion compared with $1.1 billion for the Russell 2000. It shows you, even if you were to see these stocks fall, as AMC is doing today, they would still be well within the range to move to the Russell 1000. So there go your biggest influences on the Russell 2000 just because of an index overhaul.
What's the influence on the Dow, Dave?
Well, I don't know. We'll figure that out when the Dow gets reconstituted. Actually, it's a good example.
It's getting reconstituted with the meme stocks?
I don't know about that, but the Dow and the S&P 500. This is a rolling process. Companies go in, companies come out. With the Russell indexes, it's all once a year. That's why there's so much focus on this reconstitution.
David Wilson, thank you so much. An important chart there on radio. You can see that on David Wilson's various properties today, showing sticking out like a sore thumb, GameStop, AMC, and the rest of them as well. Taylor, let me go to you first on this, and I just think it's really important. The diversification debate, it's always out there within our retirement plans, and it comes down to a blended all-in strategy or as a barbell strategy. Which is reigning supreme right now?
Barbell. I hear that all the time.
Yeah.
You'd ask Romaine about big tech, and you have to have some exposure, but you also, I hear, have to have some exposure to that reflationary cyclical growth trade. And Romaine, that is where the financials, energy come in. They're up 45, 40% year to date. They've been the big outperformers every single day. But every guest that we have on the close says, but don't ignore big tech either, because those structural issues that underwent 2020 aren't necessarily going away.
And we talk about those structural issues. A lot of the structural changes we've seen in this market is that some of those big tech names, those growth names, those former momentum names have to a certain extent become safety names. We see these pullbacks in the market, and you actually start to see flows go back into the Microsofts and the Apples of the world. They're boring, but you know what?
Are the
They're
flows
consistent.
going in yet, or is that just a prediction, Romain?
I don't make predictions, but the flows are going in. We've seen on a weekly basis flows going back into some of those big cap, mega cap names, and we'll probably continue to see that, I think, as this cycle goes. You run RG on the Bloomberg terminal, and you see that rotation, and you see how it goes back and forth with these week-to-week, month-to-month swings.
Romain, isn't the script here good jobs report, yields higher, don't own the big profitable techs?
That would be the script, but I think that script, in your words, Tom, probably got ripped up a while ago by the fact that yields don't really seem to be budging a whole lot off of this data here.
And I think Gina Martin Adams told us yesterday, Romain, correct me if I'm wrong, because it's 12 hours ago and I can barely remember, that everyone thinks that higher yields hurt tech, and to some extent, yes, but not as much as they hurt some of the other sectors.
Then, Taylor Riggs, where are we on banks? I mean, you know, there's a lot of cyclicals and values to go to, but since we speak to global Wall Street, where are banks? It's still curve steepening 101?
Last Friday, real yield, everyone said curve steepening is here. You have the anchor on the short end, and they're all betting on a growth further out, higher inflation, higher growth on the long end, curve steepening, the banks like Romain.
This is a good conversation. We should have had this conversation before I took CFA level 2.
How did that go, by the way?
But this is,
learned a lot.
For those of you on radio and TV, I mean, these are the questions the pros are going to write about off of the jobs report this weekend. I mean, I'm going to suggest, guys, everybody's waiting for this report this morning to rewrite their mid-year review. And the thing I see, Taylor Riggs, more than anything, is the mid-year review is about better economic growth than what anybody expected.
And I think Ellen Zentner, really smart on this program. We point to Michael Gapin of Barclays, who we had yesterday, striking a different tone, Tom. When you think about average hourly earnings, he's now looking at a gain of 0.3%, and the work week to remain unchanged. That is a different tone than what we've heard from Ellen Zentner, who was looking at a decline in both of those.
But the market still has to reckon with this idea that we are sort of peaking here, and now we get back down to whatever a sustainable growth rate is going to be. And there are a lot of people that are still priced at peak levels rather than at that sustainable growth level.
And to bring it back, to circle back here, folks, the jobs that we'll see here in 35 minutes. I thought Carl Riccadonna of Bloomberg Intelligence, their chief economist, was absolutely brilliant on the two jobs that out there, the obvious bartenders, restaurant, service sector going back, but he really emphasized beneath it there's an undercurrent of, maybe I'm going to say tepid data as well. It's going to lead to a very nuanced report, and we'll give that to you here in 35 minutes. Red and green on the screen. Really interesting to see what the tape does here in the next 30 minutes. We're going to drive forward the conversation. David Jones of Bank of America Securities, he is a decidedly different global investment strategist with some serious IMF analytical cred. Stay with us. This is Jobs Day on radio and television.
It's hard to have much of an inflation problem if wages are still quite quiescent.
We're recovering very quickly, but a lot of people aren't coming back into the jobs market.
People will get more comfortable coming back to work, but they're demanding more wages to do it.
The market's a little too complacent about the Fed not even talking about tapering.
2022 is going to be a year of deceleration. The economy is going to be strong, but it's going to be growing slower.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on a Jobs Day in a Jobs Hour on radio and television. We welcome you worldwide. We welcome you in England, and we welcome you across the nation as well. Coming up, David Jones. This is a really important discussion we're going to have on linking in investment and finance into the markets. But, guys, this is exciting, and Taylor made more so by the greatest miss since time began 30 days ago.
Yeah, you want to talk about market reaction to the big miss. That indeed was 30 days ago. Great chart out on the terminal that we'll put up for the radio audience as well, that markets love the uncertainty because it means that we still get the punch bowl.
Oh, the punch bowl's out there, and the dynamics of what the Fed will do. We heard from Randy Krauser, wait. We heard from Bill Dudley, wait. We heard from Glenn Hubbard of Columbia, wait. I mean, there's a lot of that assumption in the market, Romaine. We're waiting for the Fed to do something. It's not there.
Yeah, and we're probably not going to see it until, as a lot of people said, until we get to August in Jackson Hole. But at least this will give us a little bit more groundwork here for maybe what to expect, assuming that the data comes in around what expectations are. I think the question, though, is if we do get another downside miss like we had last time, I think that really changes the calculus for a lot of folks.
Well, we're going to see here. And again, I want to go to the many nuances we've seen. I thought Carl Riccadon of Bloomberg Intelligence was really good, folks, about the two-part jobs report we may witness here in 28 minutes. And Taylor, that two-part jobs report is, yes, the obvious that we see.
Right.
A lot of jobs are coming back, but beneath it, there's some real nuance, some unsettled trends where maybe it is a pause of those 8 million still unemployed.
And part of it is the wage inflation. Ellen Zentner said it great. The services sector coming back, bringing down the wage inflation, the hours worked per week coming down. Michael Gapin, though, of Barclays, seeing the opposite. So that two-part report really highlights the discrepancy that we continue to say. You do one input, you tweak it slightly, you get a broad range of outcomes on this report.
There is much going on worldwide. I do want to mention Christine Lagarde and Jerome Powell there at a summit with the Bank of International Settlements. Very important summit trying to link climate change into the future of central banks. And as we speak, the leader of Russia speaking. It is St. Petersburg International Economic Forum. Many in Bloomberg have attended this before. It is his annual confab done not by Zoom, but by people in the presence. So there's some international stories going on today. Mr. Putin speaking here on things European this morning. We're going to digress to a data check right now, not European, Romaine, Euro weaker, but much more on where we are in the equity markets.
Yeah, equity markets kind of in a holding pattern here right now. You got the S&P futures right now up about 0.1%. NASDAQ futures up as well, but really not going much anywhere. This is pretty much where we've been camped out, right around that 4,200 level right now for the past 6 weeks here. Similar story here with regards to fixed income. You're looking at a 10-year yield camped out around that 162 basis point level. The Bloomberg Dollar Spot Index also in stasis as well. To say that we're right now in a holding pattern waiting for what's going to transpire in about 26, 27 minutes here would be an understatement.
The real yield coming into a better number, a lower negative statistic, negative 0.88 is now negative 0.82. Look for the Ferro property, the real yield this afternoon. Ferro, I believe in England with some serious family matters. Our thoughts to John. And also, I believe he's doing an interview with the Tots as well. I think maybe he's on the short list to get the job at Tottenham with the Spurs. They need a coach as well. David Jones with us to begin this hour, this Jobs Day hour, with Bank of America Securities and their global investment strategist. But much more, David, I want to talk about your tour of duty at the Fed and then at the International Monetary Fund. You wrote many things on tapered tantrums. Is the tantrum to come anything that, like what you wrote about years ago at the IMF?
Well, the thing about tantrums, of course, is that they are unexpected by their very nature. Our belief is, and the work that we did at the IMF, and even at the Fed, of course, we were obviously very concerned with these issues. When you start to see the Fed move towards tightening, when you start to see the Fed reduce its monetary accommodation, that allows volatility to pick up again. And in ways, there are mechanisms in which these things become self-augmenting, and then you can have a sudden surge of volatility. When that happens, where that happens, you can never completely predict.
The inertial forces here, David Jones, are critical, and you have a subhead in your Michael Hartnett report where you say the Fed is dithering. How does a Fed dithering play into this morning's jobs report?
Well, this is the policy of the Fed at the moment. The Fed wants to see, the whites of the eyes of inflation before they actually make their move, and so they have to see these numbers pick up. What we're expecting today is, if you are a bull, for instance, what you want to see is a very high jobs number, and you want to see average hourly earnings at a very low, perhaps 0.2% or lower. That's really what you're going to need as a bull to continue with that attitude.
David, what if we get to a stage here where the inflationary pressures do prove not only to be transitory, but we actually start to see a pullback, and at the same time we start to realize some of the growth estimates, economic growth estimates in the future here? What does that do here for how the Fed is going to calculate its next move?
Well, that is actually not our expectation, to be honest. Our expectation is that inflation is going to be less transitory than people think and more permanent. We also think that growth is peaking here, and that in the second half we're actually going to see some slower economic growth, and we're going to move more towards a stagflationary outcome. That is our belief, and our market recommendations are based on that framework. If you do see something along with the Fed, what you've just outlined, very high growth and very low inflation, you're probably going to have to see that the Fed move up and start to indicate that it's going to move faster. It's going to start to wind down QE, perhaps at an earlier date and at a quicker rate, and then you're going to see the back of the yield curve pick up quite dramatically.
David, what I love is Romain and I have a raging debate in the afternoons. He thinks inflation's transitory. I think I'm more in your camp. We see it stickier than some other people think. Given that backdrop that you described and the stagflation risk in the second half, how does full faith and credit 10-year bonds react?
Well, I mean, I guess what you can say is that the first half of this year, you could describe basically as an inflationary boom. And you saw the 30-year running and at an annualized loss of close to 30%, an annualized loss of close to 30%, which is really just a staggering number. It's the largest loss for the 30-year Treasury in 100 years. And you see similar numbers on the 10-year as well. So, as far as equities went, this was very positive for cyclicals, but it did temper some of the upside for technology and for corporate bonds as well. And in the second half, we think as we move towards a slower growth outcome and we continue to see inflation stick around, we think that then argues for a sort of later cyclicals in the equity market. And we think you should also start thinking about some of the quality defensives, particularly staples and utilities.
You say a game of two halves, and the two halves, well, you can take the two halves of 2021. But, David, I'm going to take the two halves back a decade. And the overlay here that's changed is technology. How does technology play into your Bank of America work as we come out of this horrific pandemic? Is technology advance equity prices or not?
Well, technology really benefited from very low interest rates. If you think of technology, it's very, it's correlated with duration in that, when inflation, when interest rates come down, technology outperforms. We think we're now in an environment where interest rates are going to rise, and that necessitates a switch in your asset allocation framework, and that means perhaps fading technology a bit, particularly at these valuations.
David Jones, thank you. Don't be a stranger. David Jones with us, global investment strategist with Bank of America Securities today. I think really, Taylor, that underscores all the moving parts that are out there.
You asked me first, barbell strategy or not. I think David really summed it up there. So much of what we've heard, that technology is the long duration asset. If you start to think of it as a bond-like scenario, that is it. They benefit when rates come down and Romain when rates go up. That rotation out of bonds just a little bit, out of tech, back into some of those cyclical assets.
Absolutely, and the rotation that we are seeing is really one of a duration here, and that's why you saw that pickup in cyclicals for quite some time. But once you start to get not only the data that we're going to get today, but of course looking ahead to that CPI data, I think maybe you'll see people get a little bit more comfortable with that duration, with the clarity.
Romain, I look where we are, 20 minutes away from jobs. And folks, again, I can't emphasize enough the humbling we saw 30 days ago. Romain, where are flows right now? Like, where is the bet in the market? I don't have a clue besides, the meme stocks.
Well, I don't think so either. But just one thing that I think is different this time, you haven't seen as many people ratchet up their forecasts the way we saw going into last report. They sort of stayed there. And so I think that gives you a little bit of sense, and people are being a little bit more cautious this time around. I know over at Bloomberg Economics, Yelena Shilcheva, Carl Ricadana, they're around that 850 level. And that seems to be with a lot of the strategists, the non-economists that we've talked to, seem to think that could be kind of the sweet spot that they're aiming for.
I'm going to look at the Bloomberg survey right right now, Taylor, just to see where we are. We're at 675,000, and that was 674,000 just a bit ago. You talk about 1,000 change, but with the 70-plus economists there, what it takes to move that number is a lot of inertial force. Let's do this. Let me reframe with a data check here, and we'll get here to 14, 15 minutes away from this important jobs report. Red and green on the screen. Very importantly and tellingly, the VIX has come in. I don't think that's a small issue, from 18.50 into 17.95 in a little bit. S&P under 4,200, 4196. And always on jobs day for John Ferro, we quote the Dow, 34,552. The Dow cratering down 13 points on our way to the jobs report. Please stay with us on Bloomberg Radio, Bloomberg Television. It is Jobs Day.
With the First Word News, I'm Rishika Gupta. European Union regulators have opened a formal investigation into Facebook. They want to know if the social network violated competition rules by using data gathered from advertisers to compete against them in classified ads. Facebook says it will cooperate with the investigations to show that they are without merit. President Biden is turning to taxes as a way to get a compromise agreement on infrastructure. The president has pitched Republicans the idea of a 15% minimum tax on U.S. corporations. For now, the president is setting aside his proposal to raise the corporate tax rate from 21% to 28%. And Vivendi is in talks to sell 10% of Universal Music Group to a blank check firm backed by billionaire Bill Ackman. A deal would value the world's largest music company at more than $42 billion, including debt. Vivendi plans to spin off most of its UMG later this year and list it in Amsterdam. And Apple's trying to keep the momentum going for iPads, whose sales were rejuvenated during the pandemic. Bloomberg's learned the company's working on a new iPad Pro with wireless charging. It's also redesigning the iPad mini for the first time in 6 years. iPad sales soared 79% in the first 3 months of the year. And shares of AMC are lower. Yesterday, the company put its investors on another wild ride. The money-losing movie theater chain first dropped 40% of its market value, then regained more than half of it. At the same time, AMC raised more than $587 million by selling new stock in the midst of the frenzy. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Good morning, everyone. On a jobs day, Bloomberg Surveillance, Tom Keene, Jonathan Ferro, Lisa Abramowicz. Lisa and John off today, and with us, Romaine Bostic and Taylor Riggs helping out here. I'm going to call it 12 minutes away from this important report. Let me frame what we're going to do. We're going to go to Michael McKee off the report. Jeffrey Rosenberg will join from BlackRock. Really looking forward to that on fixed income dynamics as well. And then we'll turn to the equity markets with Gina Martin Adams. I think it's really must watch, must listen right on through the 9 o'clock hour. Later this morning, I will speak to the Secretary of Labor, and yes, many emails have come in. I will grill him on the wage dynamics of the nation. Right now, red and green on the screen. James Glassman joins. He's with J.P. Morgan in their commercial banking sector, truly with one of the great pulses, fingers on the tone of the nation. Jim Glassman, I want to play off a beautiful insight from Neil Dudd of Renaissance Macro yesterday, which goes to the microeconomics as was beaten into you at Northwestern years ago. And that is this great distinction, I'm going to call it the Dudd distinction this morning, of is this about more hours worked by the employed, or are we going to get to actually more jobs? Which is it?
Yeah, that's the key, and it's more jobs that really count the most, which is why the Fed says we're far from achieving their maximum employment mandate. And yeah, the national economy has gotten back to normal. Our business, the businesses I talk to, everybody's working flat out. They're much more efficient. They're able to produce a lot more with the limited resources they have. But the key to this whole story is employment, and we hope that's coming. We've got, frankly, employment is 10.5 million below where it would have been had there been no pandemic. compared to last February, yes, we're 8 million below, but the natural order of things is employment grows about 2 million a year. So there's a lot of work to do.
Heidi Shearholz at EPI has been really good on that. I'll be addressing that with Marty Walsh, the Secretary of Labor here, after the jobs report. Jim Glassman, if then we look at it, the age-old angle is I can't find employees, and I believe I'm going to hear from James Glassman, raise a wage.
Yeah, well, that's one way to do it. I think the problem, but right now there's a huge dislocation because people scattered when most people don't have the resources to hang around in Manhattan when there's no restaurant job to go to. So they scattered, and it's taking time to get everybody back into those markets again. But really the fundamental problem that we've been dealing with for 10 years is there's a demographic issue. Our workforce is not growing as rapidly as it used to, and it's getting harder and harder to find people. You got a lot of people leaving, and a 65-year-old has skills they've picked up over their life of their career, and it's hard for a 22-year-old to pick up there. That's the fundamental problem we've been dealing with, and it's when you look at the 8 million jobs that businesses say they can't find people for, it's throughout the country, it's throughout the industries. It's no one industry. And that tells you there's a demographic issue that's going on. I think the Japanese know about this. The Italians know about this. But we've never really had to deal with it because we always get immigration when we don't have the workers at home.
I look, Romaine, at where we are, and again, we come off the economic mystery of the moment. Romaine, it comes right over to the market mystery of that yield at a 1.6233.
Yeah, I've been sort of confused by this as well. I mean, when you look at some of the data that we've had, Jim, you would think that rates would be a little bit higher, particularly with some of the language that we've gotten out of the folks at the Fed here. Is there, I guess, a symmetry right now, or asymmetry, if you will, between what we're seeing with how the market is pricing things and what we're seeing out of the economic data?
I don't think so. I think we all get the idea that down the road, rates are going to normalize. I mean, the Europeans, the Japanese, the U.S., we're all buying assets, and that's, deliberately to hold down long rates. It's very difficult for people to get the timing of when this changes. And when you got the Fed telling you we're far from achieving a maximum employment mandate, and it'll be some time before that happens, there seems to be no rush. So you're right. There is a dichotomy. Rates don't belong here if everything is normal. But we're not normal yet, and it's going to take a little bit of time to get there. And, we can sit around and worry about how this is all going to work out, but I really think, we've been through this many times, and when you've got central banks buying so much of sovereign debt, it has a big impact.
Jim, I've increasingly heard that as you bring workers back and you raise wages to keep them in, raising wages isn't transitory. It's more sticky, if you will, as I'm trying to get my words out, Jim. How are you thinking about higher wages and if inflation is transitory?
Well, I think wages are going to go up. Everybody knows that, partly because they're having a hard time finding people. But, by the way, that's also encouraging them to think about ways to automate, innovate. I've talked to so many clients in the manufacturing sector that are actually working this through in their own heads. And I think, when you get all these, the workers in the hospitality and leisure fitness centers back, it's going to dampen the metrics in wages. But the truth is, I think workers are going to be doing a lot better because when you're living in a time when there aren't as many workers, it takes time for businesses to figure out how to automate. So they'll see benefits, I think.
Jim Glassman, very quickly, out on Twitter, Dan Alpert, who has been absolutely fabulous on the labor economy and, of course, his classic book, The Age of Oversupply, he really denotes that what is important today is the sectors that will hire. What are you and J.P. Morgan looking for? Where will the surprise be of who does the hiring?
It'll be the areas that have been crushed during the pandemic. So the service sector, all the guys that work in the school system, healthcare, social services, hospitality and leisure. Those are the guys that, most of us were able to transition from office to home. But it's the service sector where the lockdowns hit that are really going to be, that's where you're going to see most of the revival, I think, because that's where there's a lot of work to do.
Jim Glassman, thank you so much. Dr. Glassman with J.P. Morgan this morning. It's an historic jobs day just because of the difficulties in getting it right last time around. Taylor Riggs, I know you're going to waltz to the 9 o'clock show at some point here. What are your thoughts here as we go into this report?
Yeah, great guest coming up. Rick Reeder, BlackRock, Michael Collins of PGIM, of course, going to be asking them about if this changes anything in the way that we invest, in the way we think about real yields, those financial conditions, rising inflationary trends, and yet that magnetism of a 10-year yield at a 162. And then, of course, Romaine, as we migrate on over into the world of equities, the insistent repeated calls of this sort of reflationary cyclical trade and ditching out big tech. Where does that leave us?
Absolutely. And we talk about this sideways market, but one thing we really haven't seen was cash coming out of the market. This still remains a market that people are deeply invested in, and they're really just waiting for a little bit more of a signal as to where we're going.
Romaine, that's a really, really important insight away from the news on AMC, and I know Mike McKee's loaded the boat on GameStop. I'm not sure how that's going, but, you know, Romaine, I look at the idea that you say there's still this bid to the market. That is the undeniable fact.
Absolutely, and we've seen that continue, and a lot of the strategists we've talked to, they've really said, look, once you finally do get that clarity from the Fed here, then, I mean, assuming it's what people expect, then you're going to start to see more movement higher.
John from Coventry emails in and says, you got to quote the real yield. We'll do that for John from Coventry. Negative 0.81%. We've got a much better real yield tone off of claims yesterday, off of ADP yesterday. Coming up, we focus on the American labor economy. We'll go beneath the headline data with our Michael McKee. Stay with us on radio, on television. Bloomberg Surveillance, it is not a special edition, but it is Jobs Day. Taylor Riggs and Romaine Bostic in for Lisa Abramowicz and Jonathan Ferro. And on this momentous Jobs Day, we will have to see the market reaction to the numbers that come out. Michael McKee looks at the first glance. You see Taylor Riggs moan there. What is I'm going to call it a modest disappointment. 2 months in a row. Michael, what do you have?
Modest disappointment. 559,000 jobs were restored in the month of May. The unemployment rate does go down 0.3% to 5.8%. So we got sort of half of what was expected. Unemployment was supposed to be at 5.9, according to the Bloomberg survey, and it was 6.1 in April. The number of jobs created in April, 218,000. So that's even lower than the initial print on that. So you got to say there is a bit of a disappointment in the way the numbers are coming in right now. The total change in private payrolls, 492,000. The estimate was for 610. Manufacturing comes in at 23,000. Still a good number, but not the 25,000 that we were expecting. And the average hourly earnings are up by 0.5% on a year-over-year basis. That makes it a 2% gain, up from 0.3. And this is the thing that Jim Glassman was talking about just a few minutes ago, Tom. The fact that we're going to see a lot of bouncing around in the numbers as people come in and out of the labor force. Leisure and hospitality increased by 292,000.
Is that people, a disappointment?
That's probably a good number. It's certainly not what the ADP number suggested. They had a 440,000, but it's the people at the bars and restaurants who are coming back. Drinking places up 186,000. Takes that many people to serve you, Tom.
It does. Let me have you dive into the data here for 30 seconds. I'm going to do a data check here with equities lifting. Futures up 12, Dow futures up 28. Where you do see it's the NASDAQ, a rebound off the last 3 or 4 days. Angst in the NASDAQ as well, up 52 points, up 0.4%. I would note the 10-year yield is trying to find its way. It moved lower here starkly. And the dollar was some dollar weakness as well. There is some real activity on the screen as this is digested. And Michael McKee, I want to go to the labor force participation rate, which for anybody, including Martin Walsh as Secretary of Labor, is really not a successful statistic to see that pare back. We are not participating like the optimists would like to see.
61.6%. In April, it was 61.7%. And it tells you people are just not coming back into the labor force at the rate that the government, the Fed, would like to see. And part of the problem is obviously we don't have workers coming in, then you don't get the kind of tight labor markets that you would expect that would push up wages. There's some disappointing numbers here. Construction employment fell by 20,000. It would be understandable if it didn't grow because they're running out of workers, but the fact that they let 20,000 jobs go away is a little bit hard to comprehend. Retail trade, 6,000 jobs lost. If I were telling you a story, Tom, I would suggest that might be because people were trying to come back to retail stores that don't exist anymore after the pandemic.
Well, and Taylor, what I see is the manufacturing payrolls. This is a subsection, a number a bit below survey, but the revision a bit below as well. And this goes, Carl Riccadonna absolutely nailed this, Taylor Riggs.
100%, and I want to try to have Mike McKee nail it again for us. Mike, can you explain average hourly earnings? If you're up 0.5% month over month, Ellen Zentner, I believe, was forecasting a decline as you bring some of the services sector. As Tom, of course, talks about manufacturing, you bring the services sector back. How do you get an increase of average hourly earnings?
Well, there's a couple different ways. One could be the length of the survey period, and I haven't looked at whether this is a 5-week or 4-week, but probably the most important thing here is the composition of people who are going back to work. As we get more leisure and hospitality jobs coming back, you would think that it would pull down on average hourly earnings, and that's what happened in April. This time we didn't see that, and it may be because a lot of those jobs raised pay at the lower ends, and we'll see if that holds true throughout the next couple of months. It's an encouraging trend, but we're going to have to see several months of it if we want to get any kind of progress and a clean read on it because of the composition effects that we've seen. I want to point out the participation rate, as Tom said, dropped to 61.6 from 61.7, but the employment to population ratio, which is something the Fed is watching closely, did tick up just a little bit to 58 from 57.9. That includes the people who are out of the labor force but would like a job. They aren't looking for work because maybe they didn't think there was any, or maybe they're getting those extended unemployment benefits or something like that. And so we do see more people coming back into the labor force a little bit. The civilian labor force rose on the month, and just my thing is cutting off here by 107,000. That's a very low number. So we want to see more people coming back into the labor force, and that'll tell the Fed that we're healing.
And so, Mike, going forward here, you generally expect to see kind of more swings like this, where this kind of asymmetry in who's coming back into the labor force, who's dropping out, and such?
Yeah, the Fed is keeping an eye on certain categories in particular to see who is coming in and out of the labor force. And we're looking at women in particular. The Fed is looking to see if women are coming back. Adult women's the people 20 years and over unemployment rate does fall from 5.6 to 5.4%. Obviously, they're looking at black unemployment, a big drop there to 9.1% from 9.7. But remember, that was in the fives before the pandemic began. And the Hispanic unemployment rate, 7.3 from 7.9. So we are seeing improvement, but we're not seeing the kind of improvement that the Fed is overall looking for.
Michael McKee diving into this with further reports of the morning. Thank you so much. And I really want to underscore again the kind of economists that have looked for a two-part American labor economy. People like our Carl Riccadonna just absolutely have nailed this. Not so much the non-farm payrolls number, but just the tone of the report, the struggle as we come out of this truly national disaster. Let me reset right now and welcome all of you to our coverage of this historic Jobs Day. Futures up 11, Dow Futures up 60. Taylor Riggs with us, and Romaine Bostic as well, Lisa Abramowicz and John Farrell off on other duties today. I do want to point out critically the 10-year yield has barely moved 1.6267%. That's a good segue into Jeffrey Rosenberg with BlackRock, portfolio manager of their systematic multi-strategy fund. Jeffrey Rosenberg, what I see here on the calculus of your Carnegie Mellon is forget about the y-axis, which is where the financial media is. What really changes with these back-to-back labor reports is our guesstimates along the x-axis. How does your x-axis change as you look out into 2021 and into next year?
You know, Tom, it's a really difficult headline number to forecast, right? There was very wide range estimates. And I think the news here on this payroll report is that you're seeing signs of the supply side constraints to the labor market. And you're seeing that in some of the headline numbers, you're seeing that in some of the industry numbers. And importantly, go back to the conversation you had a minute ago on average hourly earnings. Despite a likely mix shift that should have otherwise pushed average hourly earnings downward, we're seeing that increase. And it is a similar story to what we saw in April in that average hourly earnings figure before. So for a long time, we've ignored these figures because they've been very distorted by the mix shift. The fact that you're seeing the increases in spite of the mix shift is really going to feed into this narrative of supply side constraints pushing up wages. The push up in wages will fuel and continue the debate on whether transitory becomes more permanent because it flows into wage expectations. That's to be seen, but I think that's the really important news out of this report today.
Jeff, that's exactly where I want to go. Wages aren't transitory. They're stickier. Once you raise a wage, it's harder to cut it than it is to raise it. So you're going to keep it there if you're an employer, I believe. How does this then fold into some of the break-evens, those inflationary expectations, and we fold over into a 2-year yield that is unch on the day?
Yeah, look, the short-term reactions are parsing the headline, slightly disappointing number versus some of the wage numbers. But the longer-term dynamic is, not only are wage increases sticky, but wage increases is what helps to maintain your real purchasing power, right? And maintaining real purchasing power is how companies can afford to get passed through. So for the decades in which we heard about the inability to pass through price increases to the final end consumer, now you're seeing possibly, and this will be the debate, possibly a loosening in that dynamic that will feed into this debate around transitory versus permanent. But it's an important contribution to that debate from today's report.
So for those folks in the market that are trying to sort of price this out going forward here, Jeff, I mean, we saw earlier in the year there seemed to be pretty broad conviction here about the pace of monetary policy, the renormalization of it. Will, you saw that term premium really shoot up in the first few months of the year. It's kind of flattened out over the last couple of months. And I'm wondering if today's report and the couple other economic data points that we've had over the last couple of weeks is going to change anyone's mind.
I don't think so. And I think what we've had, as you pointed out, right, it was a rapid re-estimation of the economic outlook, the Fed outlook. That flowed through the report, through the market. And now we're seeing a much stronger consolidation. The next phase is really the movement towards the impact on tapering. I think if you look at the totality of today's report, I don't think it really changes the market expectations on the trajectory of that. We'll see some signaling of that to June. Mostly it's the end of year into 2022 kind of expectation around tapering. And nothing in today's report really changes that timing.
Jeff Rosenberg, I've got to go to the obvious that pros are looking at, which is the ocean of cash that is out there. And it's real simple. It can be overnight reserves. It can be some fancy way you at BlackRock account for it. What do we do into the weekend? What do we do into June and the summer when we observe this wall of cash doing nothing?
Well, the excess liquidity in the market has been, the dominant feature of everything we're seeing going on. From financial markets to the meme stock craze, and it's not going away anytime soon. Now, the Fed is talking about tapering and maybe turning down the pace of increase. But for the short run, we are still awash with excess liquidity. And that helps to support a lot of valuations, which you see in the fixed income market across the sectors. Very tight levels of spread, very low levels of risk premium. It's a reflection of this excess liquidity. Nothing in today's Friday's report's going to change that, and that excess liquidity is very much staying with us for a while.
Jeff, you mentioned valuations. Gina Martin-Adams of our Bloomberg equity strategist writes in and says that these higher wage inflationary pressures are the next thing to hit margins when it comes to some of these companies. Is that a valuation concern as well, the squeeze that we might see now on margins?
You know, it is. And in the equity market, it's a huge theme, right? Because it's about inflation protection, right? So much what we talk about in the fixed income market, tips levels, yield curve steepeners. How do you find inflation protection for your portfolio? Well, the equity market, it's about margins and identifying which companies have the pricing power to pass through and not absorb that increase in wages, increase in commodity prices, increase in prices across the board, and not affect their margins. So that's where you're seeing the winners and losers. You're seeing the inflation baskets really focus on these companies where there is pricing power and pass-through as an effective place to put investments for this inflationary fear and for inflationary hedges. So it is about margins, and it's about identifying where do you have margin compression and where do you have margin stability and expansion.
Jeff, when you look at the economic recovery here and the pace that it's on here in the U.S. here and overlay it with what we're seeing in other countries, developed countries primarily here, do you actually see a little bit more resynchronization here of that recovery story?
You know, it's an interesting story. It's less about resynchronization and a little bit more about kind of sequencing. You know, the U.S. has been out ahead. A lot of this is obviously linked to reopening and the success with vaccinations. Europe is expected to catch up. Isn't there quite yet, but that's not so much resynchronization as it is sequencing. The U.S. success in vaccination, opening first, Europe following, and then, though not often, you know, thought of as a developed economy with respect to how you prefaced the question, you have a very different dynamic going on in China. Partly a story of sequencing as well. Much earlier into the COVID crisis, much earlier in terms of the reopening, and now at a different phase in terms of its monetary, fiscal, and credit policy. You know, looking to be more on the tighter side, and so that's not really about you know, synchronous recovery and reopening as much as it is about the sequencing of it.
Jeff Rosenberg, thank you so much with BlackRock this morning. Good to have you. And I really want to point out, folks, you have a lift in the market off of red and a little bit of red and green on the screen. You've got a nice moving up there. I'll do the data here in a bit. Taylor, what do you have forward?
Uncertainty is good news for the equity markets. That's what we're going to do at 9 a.m. We're going to have BlackRock's Rick Reeder, Michael Collins, of course, of PGIM Fixed Income, as you have UNCH on the day. That's Romain's favorite technical term. And B of A's Jill Carey Hall. We're going to go cross-asset and also take a look at, well, some dollar weakness, Tom.
On the data right now, folks, I really want to frame out what we see off this report before we get to Michael McKee. Futures up 14, Dow futures up 74. NASDAQ leads with a 0.4% move higher as well. And the VIX comes in with a vengeance. 18.50 has become 17.21. I think that's really critical to see where the VIX is as well. The real yield moves. We're at a negative 0.83%. That sustains this morning with a all in all less negative yield than what we've seen in the last 48 hours. We've got dollar weakness right now. Yen comes off 110 to a stronger yen, 109.86, and euro 121.52. Churns maybe a little bit below the euro enthusiasm of a few days ago. Michael McKee is looking at what we have wrought here. You get 15 minutes to get a lot deeper on this. What do you see in a 15-minute study?
An economy that is returning, but not as fast as people anticipated. We did see revisions to the prior 2 months. Another 12,000 jobs were found in April and March by another 15,000. So you get 27,000 additional you can add in to this 559,000. But it's not as many as people thought. They thought that we were going to see a much faster rebound than we have seen. Now, the question is the average hourly earnings rising because of composition effects, who's coming in and out of the labor force? Or does it reflect, as Taylor was talking about, the idea that maybe people are offering more money? Certainly it seems that they are in the leisure and hospitality space, but that's definitely the lowest paid of all of them.
And with regards to some of those supply chain issues, Mike, that we have been talking a lot about leading into this report, how much of that actually factored into some of the numbers that we saw, particularly with regards to manufacturing jobs?
Well, it's interesting because I was looking at that. The biggest supply chain issue that we have had is the shutdown of auto plants because they couldn't get the computer chips. However, the auto plants added another 28,000 jobs during the month, so it looks like that may be over with at this point. What may be happening is we're seeing a lot of companies that have business but don't have parts, so they haven't added people yet. But we're talking about small contractors who aren't going to show up in big numbers in these statistics.
Did this June 16th Fed meeting just change? I mean, we're trying to effort you to ask a question earlier in the session rather than the dreaded last question. But did the June 16th meeting change 20 minutes ago?
I don't think so. $120 billion a month is more money going into the economy than we need at this point. It's mostly fueling asset prices, and the Fed knows that. So they do want to begin scaling that back, but they don't want a taper tantrum. So you will probably get some hint that they are going to be talking about tapering. I wouldn't think they would do any more than that at this point.
I got like 14 more questions, but we can't do it with the news flow this morning. Michael McKee, thank you so much, and he'll be reporting through the morning on the state of the American economy. The state here is a lift in futures. Futures up 17, Dow futures up 82, and what we know is you need to be in the market to make the gain of the market, and Gina Martin-Adams has been absolutely spectacular at that before her attendance at Bloomberg Intelligence, and with Bloomberg Intelligence, our chief equity strategist has absolutely nailed be in the market. Gina Adams, do I want to acquire shares this morning?
It depends on what industry you're looking at. I think we're in the midst of a pretty significant consolidation in the S&P 500 driven by margin compression for certain industries. This morning's employment report only confirmed my view with slower than expected growth in overall employment market gains, but faster than expected wage growth. So this just piles on to an effect that we've been noting for the last 6 weeks of CPI growing, but slower than PPI. Now wages are starting to get into the game. So there's a messy margin outlook emerging for the index, which is historically means you want to be much more geared toward inflation-sensitive sectors in the commodity space and stay away from consumer and retail.
Gina Martin-Adams, the only reason I wanted to have you on is I've got to get ready to talk to the Secretary of Labor here in a bit, and you're my expert on this. Are we seeing the wage dynamics and its relationship to corporations and small business? How is that playing out right now? Is it going into margins? Are the entrepreneurs losing? Are they losing profit? What's that dynamic right now?
Yeah, it's all about shortage. It's not just supply chain shortage, but now it's also labor shortage. You're seeing a growing number of industries note that they cannot attract labor, and so they're starting to increase wage. It's very early stages, so you're only starting to see it poke its head into the employment numbers, but you certainly see it in company acknowledgement. We saw that throughout the first quarter earnings season. Mentions of inflation pressures, mentions of supply chain risks have emerged to a degree that we haven't seen since we were in the midst of the shocking tariff news in the early 2018. So companies are suggesting to us, even the largest of the large cap companies are suggesting that they are likely to see these pressures result in some degree of compression for margins. It's not necessarily across the entire index. Where you see wage pressures emerge most is very key. It's very tight for the consumer space. So food and staples retail, consumer durables and apparel, retailing at large are historically the industries where you're going to see these pressures start to actually pick away at the margin outlook. But we're seeing, the spread between PPI and CPI is impacting healthcare. It's impacting other portions of staples. It's impacting even utilities companies. So there's a lot of different moving parts on inflation. Labor is one part of it, but it's not the only thing that I think we want to keep our eye on for the index at large.
Well, Gina, then talk a little bit more about some of that divergence between, I guess, what we're seeing on the producer side with regards to prices and the consumer side, and particularly with regards to staples, which had been kind of an outperformer for a good portion of the year here, though we've seen the bloom come off the rose slightly here. Wouldn't that still provide a little bit more of an attractive, I guess, opportunity here for some investors, given some of the broader dynamics going on in the market?
Yeah, the trouble with staples is you can't paint it with one brush. There are segments that do very well in an inflationary environment. There are segments that do very poorly in an inflationary environment, and it depends on the type of inflation. As I mentioned, the one industry that is absolutely most prone to experiencing margin pressure due to average hourly earnings growth, which we saw this morning, is food and staples retail. That's a component of the staples index. If you look across the rest of the index, some food companies, food producers are in a great position because they take the price increase, they pass it directly along, but they pass it on to the retailer who has to absorb some of it in order to get that food off the shelf, right?
Yeah.
The other story is what's happening with household products. That's also a consumer staple. We are actually seeing household product companies reduce margin forecasts at this point in time. There's a big divergence happening in staples where investors are migrating to food and away from household products, and I think margins is the reason.
Yeah.
So staples is sort of at the middle of our scorecard. It's a muddy outlook. It's not an overly bullish or overly bearish outlook.
I want to get your thoughts here quickly also on the software side of the tech sector here, because when we talk about some of the price pressures there, we've seen anecdotal evidence here that some companies have not had as much success passing on costs to business consumers, and I'm kind of talking in that space, and less the consumer here. What happens here going forward if we continue to see inflationary pressures there?
Yeah, so software is a part of tech, which is also toward the middle of our scorecard, not always because of inflation, but software does have some sensitivity to rising PPI. So it's not unusual historically to see software company margins take at least a little bit of a reduction as a result of the fact that PPIs are increasing so quickly and ultimate consumer prices are not reflecting that increase in PPI. For software companies specifically, it's more about business spend than anything else. And, of course, businesses spent an arm and a leg on upping their software package over the course of the last year, given the work-from-home environment. Is that going to continue into 2021 and 2022 is a huge question. The other big thing, frankly, overwhelming the software play right now is valuations. This is a group where valuations expanded enormously in 2020. Valuation premiums reached an all-time high. Are we going to sustain that in an environment where spending is going elsewhere is a huge question mark.
Gina Martin Adams, thank you so much. Chief Equity Strategist for Bloomberg Intelligence, with the courage to be in the market from the very beginning. John from Coventry emails in. Romaine, John from Coventry notes that the Dow Jones Industrial Average is less than 1% below its peak.
Yeah.
It's been a massive drawdown.
Yeah, massive drawdown. Yeah. I mean, look, the equity markets are hanging in there. And look, we talk about the Dow only being slightly off of its peak. I think the S&P 500 is down a fraction of a percent from its peak here. So the market is in a place that I think Gina has sort of been reiterating now for the last few months, that it is consolidating, but it is still invested.
We finish this hour strong, and we do it with behavior. You can do all the theory you want, MMT, fiscal, monetary, but if you generate that flood, that ocean of cash, it's got to go somewhere. Ira Jersey is expert on this, our chief U.S. interest rate strategist. And Ira, rather than the long term, I want to go to what the Gloom Crew is going to talk about over the weekend. Are you gloomy? Are you worried? Do you have fear of the massive and near record amount of overnight reserves we see?
I'm not. And, I think there's been a lot of consternation about the amount of reserves that are in the system as the Federal Reserve has been buying a lot of assets, a lot of Treasury and mortgage bonds. They have flooded the banking sector with this, but this isn't new. We did this before in 2013, 14, 15. So we have experience doing it. I think just for whatever reason we all forgot. So, so now there's things like the Fed's reverse repo facility that's getting a lot of attention, but it's working as advertised, and it's doing the job that it's supposed to, which is keep interest rates above zero, and barely above zero, but nonetheless keeping rates above zero.
And also, I mean, it seems too, Iris, too, unlike some of the previous cycles, the Fed seems to have more components, I guess, that it can sort of normalize before it finally does get to rates itself.
Well, that's true, because one of the things that the Federal Reserve will certainly have to do is stop buying assets, right? That has to be a first and necessary condition before the Fed actually even thinks about hiking interest rates. So the question is, when will that happen? And I think when you look at the employment report today, not quite as good as people were expecting. I think that we're kind of on the path that we had laid out basically in December of last year, where the economy is getting better, but it's getting better at an uneven pace. Certainly there's sectors, and Gina just mentioned this to you guys a minute ago, there's some sectors that are doing really well, other sectors that are lagging, but until you get a more generalized increase, I think that the Federal Reserve is going to remain cautious. They're going to talk about risks, but nonetheless, they will have enough ammunition, I think, in the next few months to say, hey, we don't need the type of accommodation that we've been pumping into the market. We are going to taper probably in the first quarter of next year, but they're going to lay that out in the summer sometime.
Ira Jersey, thank you so much. Too short a visit today. Bloomberg Intelligence Chief U.S. Interest Rate Strategist. And you're going to see a lot over the weekend, Global Wall Street, on the wall of cash that is out there and deposited in overnight reserves. Romaine, I think the most interesting thing here, and this goes back to what we heard from Jim Glassman and others, including Carl Riccadonna, is the dynamics away from what everybody's focused on. And we're guilty of this in New York City, folks. I'm not going to make any, mince any words about it. This insane focus on restaurant and bars. Yeah. There's a whole other economy out there besides restaurants and bars.
Absolutely, and I think that's what really needs to be addressed here. It'll be interesting, too, Tom, to see how the administration addresses this, because this is something we've heard from the administration, that there is sort of underlying economy here that hasn't necessarily been served.
And this goes to the conversation with Martin Walsh that we're going to have the Secretary of Labor, and it really goes back to what the president will say today as well. This is not just about short-term solutions. It needs policy prescriptions, and that dovetails with Jerome Powell looking out farther. As I mentioned with Jeff Rosenberg, maybe this morning we change our x-axis.
Yeah, and I think a lot is going to change right now. But again, if you get some of these proposals that Marty Walsh and President Biden are out there pushing, if they are managed to get that through Congress, it does change the dynamics for the Fed as well.
Fascinating. I can honestly tell you 61 days ago, I never thought I'd see the two jobs reports we have just seen. That'll be the core of our discussion with Marty Walsh, the Labor Secretary for the United States, in the 9 o'clock hour, right buttressed up near 10 o'clock. Stay with us.